Okay, good afternoon, everybody. Welcome to the Bank of Finland's fourth International Monetary Policy Conference, Monetary Policy in the Shadow of Geopolitical Tensions and Trade Conflicts. When we were planning this conference about a year ago, I must admit that we couldn't imagine in the wildest dreams and imagine what kind of uncertain and unpredictable world we are living today. We are extremely pleased to have you all on board and look forward to a great conference and engaging discussions. We have excellent speakers, as you can see from the program, who are all experts in field of monetary policy, financial markets, and fiscal issues. And we have people both overseas and from Europe. So let me thank you already in advance for accepting our invitation. I'm Juha Kilponen, Head of Monetary Policy and Research here at the Bank of Finland, and will be moderating the various sessions today. Actually, this venue where we are today is called famously Whitehall, or Valkoinen Sali in Finnish. This was designed by the esteemed architect Walter Jung and completed 100 years ago in 1925. You may sense the particular decade from the walls and the decorations here. This place is actually deeply intertwined with the architectural and social life of Helsinki, having hosted everything from high society dances, academic events, and presidential addresses to city council meetings and contemporary cultural events. Now, before we get started with the program, just a couple of practical matters. Please note that the conference is on record and we have media present here. And the conference is also live streamed. Please also note that the photos will be taken during the conference. And for your convenience, the restrooms are located at the lobby where you register to the event. Regarding the sessions, and specifically for the Q&A, I will take questions from the audience here and also those joining online. And we also, of course, take questions from the media. But given that the time is limited, you may want to raise your hand promptly if you're here. And please keep your questions short and concise. Now, let me say a few words about the program. So we will start with the opening remarks by Governor Olli Rehn, and then continue with the first keynote speeches by Vice Chair Philip Jefferson from Federal Reserve Board, and then with Chief Economic Advisor Reza Moghadam from Millennium Capital Partners. After this, we have a short coffee break before the policy panel, titled as Monetary Policy under Uncertainty. And then we will finish the conference with two keynote speeches by President Christine Lagarde from the European Central Bank and Professor Erik Leeper from the University of Virginia. So let me now introduce shortly Bank of Finland Governor, Dr. Olli Rehn. Olli has been a chairman of the board of the Bank of Finland and a member of the ECB Governing Council as of July 2018. But Olli joined the Bank of Finland already in 2014 as a member of the Bank of Finland board. Olli has served in various European and international positions and gained expertise on EU policies while serving as a vice president of the European Commission and the European Parliament. At the Commission, he has been responsible for EU enlargement and fiscal and monetary matters. Olli is also a very well-known figure in Finnish economic policy and politics. He served as a Minister of Economic Affairs in Prime Minister Sipilä's government in 2015 to 2016, and he has been member of the Parliament also in 1991 to 1995. Olli is a Doctor of Philosophy from the University of Oxford with the International Economics as his major. So with this short introduction, Olli, the floor is yours.
Thank you, Juha, for your kind words of introduction. And welcome everybody to Helsinki and to this White Hall. Ladies and gentlemen, dear friends, it is indeed my great pleasure and honor to welcome you all to the Bank of Finland's fourth monetary policy conference on the very timely and critical topic of monetary policy in the shadow of geopolitics and trade tensions. In fact, I could welcome you also to the fourth oldest central bank in the world. The Bank of Finland is founded in 1811, that is 214 years ago. And I could have done so almost literally in a sense that the Bank of Finland then in 1811 started at this very spot in the same complex of houses in the corner, which is called the Söderholm House, which is practically the oldest house remaining in the center of Helsinki. Since then, we moved at least twice, first one block and then two blocks where we have been located, 2 blocks northwards from here since 1883. Today's subject is of critical importance for central banks and the whole financial community. Politics and economics have always been intertwined, but now geopolitical tensions and tariff wars make up a unique set of challenges in our operating environment. The long-time anchors of economic stability, that is open trade, global governance, predictable international relations, are currently under strain. In this new reality, we must better understand the uncertainties of the more fragmented world for the sake of sound policy making. I will say a few words on central banks' strategies in this new normal shortly, but let me first continue where you have started and further introduce today's program and speakers concerning the key substantive focus. I'm especially honored to welcome our first keynote speaker, Philip Jefferson, Vice Chair of the US Federal Reserve Board of Governors. Vice Chair Jefferson, dear Philip, your insights on these matters are invaluable, and we are eagerly waiting for your views on the challenges facing monetary policy today. Thank you so much for joining us today. We are likewise very much looking forward to listening to Christine Lagarde, President of the European Central Bank, later today. Her leadership, policy insight and stamina are essential as we pursue teamwork to ensure price and financial stability, thus supporting the foundations of sustained growth and employment in the euro area. Today we are also very pleased to welcome Chief Economic Advisor Reza Moghadam from Millennium Capital Partners. Reza is a voice of great experience, having served in key positions at the IMF, for instance, as the European Director during the Eurozone crisis years when we had long nights together several times per month at Justus Lipsius in Brussels. And Reza will give us a keynote with case studies on different types of market reactions to geopolitics and monetary policy. We are likewise most honored to have with us Professor Erik Leeper of the University of Virginia, who will be speaking on the fiscal foundations of inflation. This is a crucial topic as fiscal and monetary policies seem to be more interconnected than ever, and Professor Leeper's expertise will surely challenge and inform our thinking. After the coffee break, we'll have a most interesting and topical policy panel in which experienced policymakers, Governor Erik Thedéen of Sveriges Riskbank, Deputy Governor Clare Lombardelli of the Bank of England, and Deputy Governor Agnès Bénassy-Quéré of Banque de France will discuss monetary policy making in times of uncertainty. Our board member, Tuomas Välimäki, will moderate the discussion. Led by our distinguished, experienced speakers and panelists, we have today a great opportunity for a substantive and lively discussion, and thus for seeking new elements for thinking about sound decisions in monetary policy and beyond. Dear friends, let me now set the scene by briefly reflecting recent developments in monetary policy strategy. The strategy of the European Central Bank has been reviewed and renewed twice during the current decade, in the past 5 years only. First in 2021 and then earlier this year. And the 2021 strategy review was preceded by a long period of low inflation, too low inflation, and of interest rates at the effective lower bound. And here we have the ECB's old definition of price stability pre-2021, below but close to 2%, which was open to different interpretations. The 2% inflation was often interpreted as a ceiling in this definition, and in our view, there was an evident need for clarification. Recent research by Bank of Finland economists applying textual analysis and language models to communication indicates that the ECB's policy preferences were indeed asymmetric during the first 2 decades of the euro, as the ECB was, or the Governing Council was more averse to inflation above 2% than below 2%. Such asymmetry in policy preferences gave rise to a disinflationary bias in monetary policy. And that was the key reason for launching the strategy review of 2020-21. The most important change then in the revised strategy was the introduction of a symmetric 2% inflation target over the medium term. Applying the same textual analysis tools to this most recent period, our researchers at the Bank of Finland have found suggestive evidence that the ECB's policy preferences have become considerably more symmetric after the new strategy was adopted in 2021. Moreover, so-called make-up strategies, such as average inflation targeting, not so much average price level targeting in our case, but average inflation targeting, were dealt with in depth during the 2021 strategy review. In the end, we did not adopt a strict make-up strategy, as it would have posed major analytical policy and communication challenges. Yet our strategy still contains an element that would allow compensating for too low inflation if we were to fall back into a liquidity trap, which we of course aim at preventing in advance. This year's ECB's strategy assessment took place after a period of high inflation in the context of pervasive uncertainty. Here you can see on the screen, you can see, in fact, 3 or 3.5 periods of inflation in the euro area. First, from the start in 1999 until post-financial crisis 2009, when the inflation was, as Jean-Claude Trichet used to slightly brag, 1.97%. So can it get closer to below, but close to 2%? Then came the, say, disinflationary or deflationary danger, and we had too low inflation for almost 1 decade, when inflation stood at around 1%. And then in 2021, we had a spike, we had a surge in inflation, and it has been now brought back to the target at around 2%. So why is this important? It is because we judged in our latest strategy review this year, earlier this year, that the new definition or the revised definition of price stability has served Europe well, especially considering that the 2021 review aimed at a strategy that works in a low inflation environment, while we were in fact hit by a sudden and large upward inflation shock and a surge in inflation. Perhaps this is not so surprising, as any inflation targeting framework is essentially, by definition, a strategy to contain high inflation. Hence, we took the view of if it ain't broke, don't fix it, and decided to keep the definition unchanged. The clarity of the point target has in particular helped to anchor inflation expectations and contribute to clear and comprehensible communication. Furthermore, the second key aspect of strategy, the medium-term orientation, was reconfirmed in this year's strategy assessment. It allows for temporary deviations from the 2% inflation target, and thus gives monetary policy flexibility to look through if inflation varies, for instance, due to temporary supply shocks, and if the inflation expectations remain firmly anchored. However, there are also novel elements in the latest 25 assessment. The updated strategy calls for new ways to analyze and communicate uncertainty, especially with the help of scenario analysis. We read the Bénassy-Quéré review of Bank of England, but we also came to this conclusion by our own. This is a key lesson of the shocks that have hit the euro area recently, both the COVID-19 and Russia's illegal war in Ukraine and the energy crisis following it. Scenario analysis can be a useful tool in mapping possible developments and discontinuities, outlining consistent narratives, and preparing policy responses. The appropriate response is always, however, context-specific, as different uncertainties lead into different types of policy trade-offs. Drawing from past experiences, the updated strategy also states that the ECB should react forcefully or persistently to significant positive or negative deviations from the 2% target. In fact, both approaches have been used. They were already used in the ECB hiking cycle from June-July 2022. First, the ECB Governing Council acted forcefully by swiftly raising the policy rate. In the second phase, we acted persistently by communicating that the rate would be kept at the given elevated level as long as necessary to curb inflation. In other words, at the 4% level from September 23 till June 24. Likewise, in the current easing cycle since June last year, June 24, we have acted consistently by bringing the policy rate from 4% to 2% just in a 12 months period of time. More generally, in terms of strategy, a forceful policy response to significant deviations from target enables to keep inflation expectations firmly anchored. Even so, there may come a point where persistence, relying on clear communication and guidance rather than further rate hikes, can become a more effective and meaningful approach. Recent work by Bank of Finland economists indicates that persistence may deliver a more favorable stabilization trade-off, i.e. a lower sacrifice ratio. Dear friends, at the same time, these are not the only challenges confronting central banks today. Today's international monetary system is under pressure from both geopolitical confrontation and technological innovation or disruption. You can choose which word you want to use. History reminds us that often such transitions from the end of the gold standard to the collapse of the Bretton Woods system have brought instability and inflation, sometimes deflation. As President Christine Lagarde has said, this is truly a global euro moment. We have a great opportunity to make the euro a trusted global anchor of stability, This calls for a strategic rethink and bold action so that it can support a healthier, more meaningful rebalancing of the global monetary order. So, ladies and gentlemen, I cannot possibly close my introductory remarks without reference to one uninvited elephant in the room, that is the challenge to independent central banks. Both theory and real-world experience underline the critical importance of central bank independence. To illustrate the point, we can compare the recent interest rate hiking cycle to earlier similar cycles. Inflation did surge to uncomfortable levels in many economies in recent years. Yet central banks, including the ECB, the Bank of England, Sveriges Riskbank, and the Federal Reserve, were able to bring inflation down rather swiftly without inflicting severe damage on real activity. While many factors certainly played a role, research and policy experience suggest that central bank independence and credible inflation targets were crucial. They were critical. The recent cycle contrasts sharply with, say, the 1970s, when inflation remained persistently high after the oil shocks in the advanced economies, both in Europe and in the US and beyond, or to the early 1980s, when the Federal Reserve under Paul Volcker had no choice but to steer the economy into a recession in order to tame inflation. Well, Volcker truly stood tall also physically at 6 feet 7 inches or 201 centimeters. While there is a little Paul Volcker in every central banker, I must say that I very much prefer to tame inflation without having to impose vast economic ramifications and social and human costs that were unavoidable in his era. And that's precisely why central bank independence and the credibility it brings is so essential. Let's stick to it. So, dear friends, welcome and thank you all again for your presence. And I hope you will find today's conference both stimulating and informative. Thank you.
Thank you, Olli, for these very insightful opening remarks, setting very nicely the stage for this conference. We are actually a bit ahead of time, which is excellent. And our next speaker is Vice Chair Philip Jefferson from the Federal Reserve Board. He will talk about monetary policy frameworks and the US economic outlook. Let me just say a few words about Philip. So Philip have served a distinguished career in public service and academia, and he joined the Board of Governors in May 2022 and took office as a Vice Chair of the Board of Governors at the Federal Reserve System in September 2023. Most recently, Dr. Jefferson has been Vice President for Academic Affairs, Dean of Faculty, and also Paul Freeland Professor of Economics at Davidson College. Among others, he has also served as an economist at the Board of Governors. Dr. Jefferson received a BA in economics from Vassar College and MA and PhD in economics from the University of Virginia. Without further ado, Philip, the floor is yours.
Okay, I think we'll get the right slides. Okay, well, I'm going to start, even though the slides, I'm guessing, will be forthcoming. So, there you are. Very good. Well, Huva Paeva. Thank you. Thank you, Governor Rehn, for the invitation to visit the lovely city of Helsinki and participate in the Bank of Finland's International Monetary Policy Conference. I highly value the opportunity to interact with and learn from my fellow central bankers, so thanks again for having me. When considering the Bank of Finland, the European Central Bank, the Federal Reserve in the United States, it is easy to point out some differences, including our mandates and our economies. But there are also important similarities across these central banks. As independent central banks, our objective is to set policy that will result in the best outcomes for the people we each serve. Another similarity, and one that I would like to focus on today, is that both the ECB and the Fed see value in establishing and clearly articulating to the public a framework on how we each approach monetary policymaking. And in fact, both the ECB and the Fed published revisions to our individual framework documents earlier this year. Such revisions lead to a more robust frameworks that help support the mission of central banks across a broad range of economic conditions, including those that are shaped by geopolitical tensions and trade conflicts, as is the theme of this conference. Today, I will briefly review some consistent themes that emerge from these two revised documents. Then, I will discuss in more depth changes to the Fed's statement on longer-run goals and monetary policy strategy, which Chair Powell announced in his Jackson Hole speech in August. Finally, I will offer my views on the economic outlook and its implications for U.S. monetary policy. Understanding the work of other central banks and speaking with their policymakers is a healthy exercise. This is particularly true when studying other banks' overarching frameworks. The ECB's monetary policy strategy statement dates to the central bank's founding in 1998. The Fed is quite a bit older, but it still took us longer to offer a formal framework to the public. The Fed's statement on longer-run goals and monetary policy strategy was first issued in 2012 under Chair Ben Bernanke's leadership. At that time, Fed leaders took note that other peer central banks issued public statements of their frameworks and saw value in doing so. While the two documents differ in length and touch on some slightly different topics, reflecting each bank's unique mandate, there are several similarities. One is that the governing bodies, both the ECB and the Fed, target 2% inflation. Another is that they both have a commitment to revising and revisiting their framework periodically. Also, both documents de-emphasize their previous focus on operating near the effective lower bounds of interest rates in favor of considering a broad range of economic circumstances. Overall, both documents describe the central bank's understanding of its monetary policy mandates and its broad approach to achieving them. However, neither is a mandatory policy prescription. Indeed, each framework provides a structure within which its respective policymakers can develop their individual policy views. That's a good thing. It's a sign of a healthy, independent central bank. Robust discussions where alternative viewpoints are considered are more likely to lead to effective policies and better outcomes for the people we serve. Now let me turn specifically to the framework document my Federal Open Market Committee colleagues and I finished revising in August. The Fed's dual mandate to foster maximum employment and stable prices, which was given to us by the U.S. Congress, underpins the Fed's monetary policy framework. Our commitment to delivering on our dual mandate is unwavering. The revisions to our framework will support that mission across a broad range of economic conditions. We often refer to the framework document as the consensus statement. We call it that because it reflects the consensus view of the FOMC, and because having a 9-word title for a 2-page document is a bit verbose. The FOMC created the revised consensus statement after conducting a public review, the second time the committee has done so. That review consisted of 3 elements. First, we held Fed Listens events around the U.S. where members of the public could share their views with policymakers. Second, we hosted an academic research conference that featured presentations from leading experts, including former Chair Bénassy. And third, we convened a series of policymakers' discussions and deliberations at FOMC meetings this year, supported by staff analysis. The statement is designed to give the public a clear sense of how we think about monetary policy. And that understanding is important both for transparency and accountability, and for making monetary policy more effective. The changes implemented as a result of this review were a logical progression, not a change of course, grounded in our ever-evolving understanding of our economy. I will make note of 4 adjustments to the consensus statement and discuss each in turn. First, the revised consensus statement removed language emphasizing the effective lower bound as a defining feature of the economic landscape. Instead, it states that our monetary policy strategy is designed to promote maximum employment and stable prices across a broad range of economic conditions. This revision, reflecting a move away from the post-financial era crisis era of historically low interest rates, makes our framework more robust. It is useful to recall that at the time of the FOMC's previous framework review, during 2019 and 2020, policymakers were considering an economy that for many years demonstrated low growth, low inflation, and a very flat Phillips curve, meaning that inflation was not very responsive to slack in the economy. The overarching concern for central bankers at that time was how to operate with interest rates near the effective lower bound. Today, of course, we are operating in a very different environment, at least in part brought on by the economic consequences of the pandemic. Second, the revised framework embraces a flexible inflation targeting approach at all times and eliminates the makeup strategy that would be employed in certain circumstances. The experience since the pandemic highlights different challenges to achieving our inflation mandate, such as supply shocks, sectorial developments, and nonlinear inflation dynamics. The flexible inflation targeting in our revised frameworks allows us to take a balanced approach in promoting our goals, considering the extent of departures from them. The revised framework appropriately emphasizes the committee's commitment to ensuring that expectations remain well anchored. Third, the revised consensus statement provides clarity around how the committee thinks about maximum employment. The 2020 version of the statement indicated that the Fed would mitigate shortfalls from maximum employment. The shortfall strategy grew out of the insight that real-time assessments of the natural rate of unemployment, and hence maximum unemployment, are highly uncertain. However, the use of the word shortfalls created some communication challenges, as it was not intended to be a commitment to always avoid preemption or to ignore tight labor market conditions. As a result, it was removed from the consensus statement. Instead, the revised document more precisely states that, quote, the committee recognizes that employment may at times run above real-time assessments of maximum employment without necessarily creating risks to price stability. As Chair Powell pointed out, Preemptive action could well be warranted if tightness in the labor market or other factors pose risks to price stability. The revised statement defines maximum employment as the highest level of employment that can be achieved on a sustained basis in the context of price stability. Fourth, and closely aligned with the change I just discussed, the FOMC clarified its approach to monetary policy in times when the employment and inflation sides of our mandates may be at odds. The revised statement says that in such periods, the committee will follow a balanced approach in promoting them, taking into account the extent of departures from its goals and the potentially different time horizons over which employment and inflation are projected to return to levels judged consistent with its mandate. The revised language more closely aligns with the original 2012 statement. It is also consistent with the committee's actions during the 2022 to 2024 period, when the departure from our 2% inflation target was an overriding concern. While I have highlighted multiple changes, it is also important to note the continuity with the Fed's past framework statements. The document continues to explain that we interpret the mandate Congress has given us and describes the policy framework that we believe will best promote maximum employment and price stability. We also continue to believe that monetary policy must be forward-looking and consider the lags in its effects on the economy. We have never set a numerical goal for employment because the maximum level of employment is not directly measurable and changes over time for reasons unrelated to policy. Likewise, we maintained our commitment to a 2% inflation objective because that is a key factor helping keep longer-term inflation expectations well anchored. And we remain committed to conducting a public review roughly every 5 years. While the framework provides a structure through which to think about policy decisions, I will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. Consistent with such a determination, I would like to share with you my current outlook for the U.S. economy. Recent data indicate that U.S. economic growth has moderated and the risk to both sides of our dual mandate have shifted. Employment growth has slowed because of weaker growth in labor supply and a softening in labor demand. The uptick in the unemployment rate suggests that demand has fallen by a bit more than supply, and that the downside risks to employment are rising. Meanwhile, higher tariffs are showing through to higher inflation for some goods. I expect that the effect of tariffs on inflation, employment, and economic activity will further show through in coming months. The softening of the labor market activity comes as overall economic activity has moderated this year. In the first half of 2025, U.S. GDP grew at about 1.5% at an annual rate, which reflects a marked cooling from last year's 2.5% growth rate. The slowdown in economic activity in the first half of this year was primarily driven by weaker consumer spending. That said, U.S. retail spending picked up over the summer. Overall, I expect the U.S. economy to maintain the first half rate of growth throughout the remainder of this year. In terms of the labor market, there's been notable slowing in both labor supply and labor demand. Net immigration into the U.S., an important contributor to workforce growth, has dropped sharply. At the same time, total employment growth has slowed. Over the past 3 months, American employers have added just 29,000 jobs to payrolls a month on average. The recent pace of employment growth has been the slowest since the U.S. economy recovered from the COVID-19 pandemic recession, which is largely explained by the slower growth in the labor force. There are other measures of the labor market that also bear watching. For example, the ratio of unfilled jobs to unemployed Americans seeking work remains near 1, and measures of job openings and initial job claims have been mostly moving sideways. A low level of job creation would historically put upward pressure on the unemployment rate, though so far that effect has been muted because of the decline in labor force growth. The U.S. unemployment rate in August was 4.3%, a still relatively low rate and up just 0.1 percentage point from August of the previous year. The unemployment rate could edge a bit higher this year before moving back down next year. Turning to the other side of our dual mandate, it remains notable that inflation has slowed considerably from the highs that occurred when the economy reopened after the pandemic disruptions. Inflation, however, remains somewhat above our 2% target, and the tariffs that have been announced and implemented so far are showing up in some goods prices. Overall, consumption expenditure prices rose 2.7% over the 12 months ending in August. Core PCE inflation, which removes volatile food and energy prices, was 2.9% in August. Often, it is helpful to study the 3 major components of core PCE inflation. Currently, core goods prices have been rising, reflecting tariff effects. In contrast, core services inflation outside of housing has generally trended sideways this year, while housing appears to be on a gradual downward trend. I view the uncertainty around my baseline outlook as especially high, mainly due to the new policies being introduced by the current U.S. administration and their effects on employment and inflation. As the changes in these policies are finalized, and we have more time to judge how they are affecting the economy, I expect some of the broader uncertainty around the U.S. economy to diminish. Considering the outlook I described, I see risk to employment as tilted to the downside and risk to inflation to the upside. It follows that both sides of our mandate are under pressure. While tariff-related inflation is apparent in the prices of some goods, it is also notable that it so far has been lower than what many forecasters predicted this spring. Several factors, including the final tariff rates, the extent of pass-through to consumer prices, the effect on supply chains, overall economic conditions, and what happens to longer-run inflation expectations will influence the scope and persistence of the related rise in inflation. Short-term inflation expectations have come down from the peaks reached in the second quarter, and most measures of longer-run inflation expectations have been largely stable, suggesting that the American people understand our commitment to returning inflation to our 2% target. As such, I expect the disinflationary process to resume after this year and inflation to return to 2%, to our 2% target in the coming years. With the unemployment rate at 4.3%, the labor market is softening, which suggests that, left unsupported, it could experience stress. To balance the risk of persistent above-target inflation and the risk of a deteriorating labor market, I supported a 25 basis point cut in our target range at the last FOMC meeting. This change moved our policy rate closer to a more neutral stance while maintaining a balanced approach to promoting our dual mandated objectives. With respect to the path of the policy rate going forward, I will continue to evaluate the appropriate stance of monetary policy based on incoming data, the evolving outlook, and the balance of risks. I will also consider and assess information about government policies and their effects on the economy. In this room, I know that I am not alone in putting careful thought and attention into what should be the proper path of monetary policy moving forward. I have found the Fed's consensus statement to be a valuable tool in helping me organize my thinking and take a grounded approach to policymakers. I know that similar documents at your central banks also provide wise counsel to pursue your mandates. Thank you again for the invitation to speak here and for allowing me to engage and share ideas. Thank you.
Philip, for excellent keynote. We have now actually quite plenty of time for questions, so who would like to start? Please, from there.
Hi, I'm Erik from Varma, and thanks for the very illuminating speech about the thinking around the targets. And one question that has risen recently is the impact on what is the US labor force doing. And it seems to be shrinking, or at least the growth has slowed down considerably because of the immigration policies. And what do you think that would be the implications for the potential GDP growth going forward, and therefore the appropriate neutral rate going forward?
Thank you for that question. And as it was preferenced, and I think I do mention this in my remarks, it has been the case that labor force growth has slowed. And so we would expect that if it were to continue, if it were to be a trend, that that would have an impact on potential GDP, okay? But that also has an impact on actual GDP. And what really matters for monetary policy is the output gap, right, over time. And so what we will have to see as we go forward is what happens to the output gap as these demographic changes take place. And that is what will ultimately influence my thinking about the appropriate path for monetary policy. And I should say, before I go any further, as I'm answering these questions, I'm speaking only for myself and not for the board or the FOMC.
Thank you. I think we have one question here, gentlemen, and then over here. Thank you.
Thank you very much. I'm Stefan Gerlach from EFG Bank. In the past, it was often said that central banks should look through the effects of the tariffs because the increase in inflation was most likely to be temporary. I think you said something more interesting than so, which is that an increase in tariffs could impact on the demand for labor as well, and that would have implications for the Fed's mandate and would warrant, in that case, more stimulatory monetary policy. That was one reason for why the FOMC cut by 25 basis points most recently. Is that interpretation correct?
I'm going to start with the last part of the comment or question. And again, speaking for myself, it was the case that I was concerned about softening in the labor market. And in terms of the impact of tariffs, I want to focus more so on what's been happening in the labor market, because it could be multiple things that impact the demand for labor. What we've noticed, and what I've tried to document, is that we've seen the demand for labor come down, but it's also been the case that the supply for labor has come down. And that is what's led to this unusual type of labor market balance, where we see labor supply and labor demand coming down. We see the unemployment rate moving kind of sideways, but also increasing a little bit. So if you believe the impact of the labor demand decline is slightly more than the decrease in supply, and you're looking at labor market conditions, then it might be the case that you would say, well, now it is appropriate to provide some support to the labor market. Because we know historically that changes in the labor market on the downside can happen quite quickly. Luckily, layoffs, for instance, have been quite stable in the United States recently. And certainly, I don't think we need to see any additional softening in the labor market, given that it's in relative balance.
Thank you. Next one.
Thank you very much for a great speech, Beat Siegenthaler, Rocos Capital. I was curious whether you could tell us anything about the current restrictiveness of rates. There's obviously a debate between FOMC members where the neutral rate might be and how restrictive current rates are. Yesterday, Beth Hammock, Cleveland Fed, was talking about there being only a small distance to neutral and rates were only a little bit restrictive. Governor Myron, on the other hand, obviously sees neutral a lot lower. So I was wondering where you were in that debate. Thank you.
Again, I want to emphasize that I'm only speaking for myself and not for my colleagues. With respect to this question is really about my view of where the neutral rate is. That's how I'm interpreting it, okay? And the short answer to that is I am uncertain about where the neutral rate is. I know that it is a very valuable theoretical concept, but as an actual policymaker, I have to embrace the uncertainty around where it might lie. And so that leads me to want to move carefully and deliberately so as to bring rates towards a more neutral stance. We've been pausing for the better part of a year, and so at this time, given what I can see about where the economy is, and as I mentioned, the labor market, balancing the risk against the current inflation readings, it is my view that a 25 basis point cut at the last meeting moved us towards the neutral rate. And so that's as far as I'm willing to venture, given the uncertainty bands that I place around the exact location of the neutral rate.
Thank you. Any more, please?
Thank you. I'm Anna Kaurunen from Reuters News. I would like to ask Vice Chair Jefferson, do you plan to retain your seat as a Fed governor after this term, as the Vice Chair term expires in 27? Thank you.
That is, well, let me say what I am focused on. I have not given that thought at all. Okay, my focus is to do the job that I currently have right now to the best of my ability, and to keep my focus on the economy and trying to make the best decisions with regards to monetary policy. Your question pertains to something that is far in the future, and it is not something that I think about when I come to work every day.
Thank you. Please, over there.
Thank you very much for your speech, Pekka Petra from OP. Could you comment anything considering the presidential regime, what is now in US, and the independence of Federal Reserve?
I'm sorry, I didn't hear the first part of the question.
Yes, considering the presidential regime, what is now in US, and federal independence, could you?
No, I have no comment around that.
Thank you.
Mm-hmm.
Anybody? Yeah.
Yep, thank you. Antti Ilvonen from Danske Bank. Your colleague from Dallas Fed, Lori Logan, last week proposed that the Fed should consider changing its policy rate target from the Fed funds rate to perhaps the tri-party general collateral repo rate. Do you have any thoughts on that?
All I would say around that issue is that in our recent statement of monetary policy, what I referred to as the consensus statement, it was affirmed that our primary policy instrument is setting the target of the federal funds rate.
We have still some time for 2 or 3 more questions.
See, I've answered all of the questions with time to spare.
I don't think
and it's okay. I mean, so we don't have to.
Maybe I can. I was thinking when you presented at the early part of your presentation, you talked about shading a bit away from the focus on the ELB and in the new strategy. Mm-hmm. So would you consider that the probability of hitting the zero lower bound would have changed in the current environment a lot from what we were, say, decade or 5 years ago or so? And the second part of the question, if you would hit the ELB, would you consider the same policy instrument still relevant, what you used in the past?
I believe that the probability, given the recent history, the probability that we would enter a zone of where the effective lower bound became highly relevant, that probability has gone down. In terms of the conduct of monetary policy in our new framework, which I think is robust to a variety of economic conditions, what I would want to emphasize, and this is consistent with the statement itself, is that the Fed stands ready to use all of its tools to fulfill our mandate. So I think that across a broad range of economic conditions, we would want to be prepared to do that if that was the appropriate course of action to help us achieve congressionally mandated objectives.
Thank you. Erik, please. Last one.
Erik Leeper, University of Virginia. One thing you didn't say anything about with the consensus is there some consensus at the Fed about the size of the balance sheet? Presumably, if you're going to stay in the current abundant reserves regime, there are limits to how small it can go. And I'm just wondering whether there's a view about what you see as the long run, or the Fed sees as the long run size of the balance sheet.
Well, okay. Thank you for the question. And I think that this is a topic that board members think differently about. And I think that's a healthy discussion. What I would emphasize is what has happened recently is that, one, a few years ago, we announced a policy path for reducing the size of the balance sheet. So far, it has, since that time of that announcement, it has shrunk by over $2 trillion. So that process is continuing in a very orderly way as we go through this period of time. And the ultimate size of the balance sheet is one that will depend on the demand for our liabilities, you know, currency and reserves and things of that sort. The determination of, you know, what is the ample size of reserves and whether or not it should be smaller, that's a decision for the FOMC as in its entirety. And I know and respect that there are different views about that. And so we will have to see where that ultimately lands. But it is the case that we said very clearly that we are moving towards an ample reserve regime, one that is consistent with the demand for our liabilities as the economy grows over time.
Thank you, Philip. So please join me to thank Philip for excellent keynote. Thank you so much. All right, so we will continue. We will change the gears a little bit now. We have next Chief Economic Advisor, Reza Moghadam from Millennium Capital Partners. Just let me say again a few words about him. So his mandate, as his current position, spans global macroeconomic policy research, as well as advising clients across the banking, capital markets, and investment franchises on global economic and policy issues. Prior to his role, Reza was Morgan Stanley's vice chairman for sovereigns and official institutions. Before joining the Morgan Stanley, Reza served for 22 years at the International Monetary Fund, and I have also learned that it was ECB president, current president, Madame Lagarde, who is with us today, who appointed Reza to head the IMF's European department during the Eurozone crisis. Before this, Reza was involved also in the IMF's response to global financial crisis when he was the head of strategy, policy, and review department at the IMF. Reza holds a BA in Mathematics from Oxford University, MA in Economics from the London School of Economics, and PhD in Economics from the University of Warwick. Reza, the floor is yours.
Thank you very much for having me here. It's a real pleasure to see so many familiar friends from both inside and outside Europe, and a pleasure to be here to share some thoughts with you. I called my talk a personal perspective. It's personal in two respects. The first is it is really a personal view, and it does not reflect the views of my employer at all. It is a personal view. The second is that I talk about a few episodes of previous crises, and these are episodes that I was personally involved in some capacity. So what I will do today is I will talk about two cases of major financial stress, and one in an emerging market, another in the Eurozone, and one is very familiar to you, Olli. And then, time permitting, I'll make a few comments about the state of the markets currently and the impact of some of the geopolitical risks we face. So let me start with a chart on the first case. What's that? It's the left button. It appeared. I mean, I show you the chart first, and then I'll describe the episode. And it's to me an incredibly dramatic chart. So this is the chart of credit default swap, 5-year credit default swap for Brazil. And as you see this massive spike in 2002. Just a word about the magnitude of that spike. We are talking about a CDS spread of almost 4,000. That means you have to pay 40% of the face value of a risk in order to insure it. What does that mean? It means if you have reasonable calculations on rate of recovery, you're talking about a default risk of a country of close to 7% in 1 year, close to 100% over the 5-year period of CDS. So you're saying essentially the government is going to default any moment. So what was the cause of this? Now, in many of the cases that I've dealt with, usually you have macroeconomic imbalances, policy imbalances within a country that lead to crisis. But often there are political elements, geopolitical elements, they do go across borders. And the reason I chose this case and the other case where they're closer to the title of the conference, which is impact of geopolitical risks. But in this case, it was a major political risk. What was the risk in 2002? They had an election, and a very famous president now, President Lula, was for the first time running. This was in October 2002, and that's where you see the run-up to the CDS spread going sky high. Just before that, as the opinion polls were showing that Lula was increasing its support and was very likely to be elected. Now, why were the markets reacting like this? A little bit of background. Brazil had gone through major economic upheaval, which it had quite successfully managed over the previous few years. And there was a the Asian crisis, which put focus on foreign debt. I'll come back to that, on FX-denominated debt. There was the major geopolitical risk of 9/11, where the risk translated into a massive risk aversion by the market risk aversion relative to the emerging markets, including Brazil. And many emerging markets had to, a number of them were pegged, like Turkey, like Argentina, like Brazil, and they all depegged. But Brazil managed that period quite successfully. A very famous episode was when President Cardoso appointed Arminio Fraga, and Fraga, for the first time in a major emerging market, introduced inflation targeting as the basis for conduct of monetary policy in Brazil. So they had a very successful stabilization process in the years before, after massive number of shocks. But the market was extremely worried, what would the new government mean? And so the risk of default. Now, what was the underlying vulnerability that caused that? The underlying vulnerability was, one, obviously, politically, it was not clear what the government policies would be and whether there would be continuation of some of the policies that had been pursued. But there were two key issues here. One was almost half of the debt was denominated in foreign currency. As you had market pressure and the exchange rate was depreciating, the face value of the debt was going up on a daily basis. And secondly, that required massive fiscal adjustment. The government had targeted a primary surplus about 4% of GDP. And those were, the markets viewed it as in jeopardy. So what was the solution? As you see, there was a solution which brought that CDS spread massively down. And over time, we have never been, there have been episodes, you can detect, for example, 2008 episode there, where there was a little bit of spike, but never like that. What was the solution there? It was quite a novel solution, and it was essentially proposed by Arminio Fraga and Pedro Millán. Pedro Millán was the finance minister at the time. Their solution was to have an IMF program, that's hence when I was involved, to an IMF program which not only committed the current government to some of the existing policies, but it was a program that went over at least the first year of a new government. So in a way, policy credibility was being questioned, and they borrowed credibility by having an IMF program. Now, the tricky part there was, of course, no current government can commit the future government to what the policies would be. So what happened there in a typical sort of IMF finding a solution that would apply in these circumstances, President Lula issued a letter to the Brazilian people. Now, usually with the IMF programs, as you well remember, Olli, you have letters of intent by the government. So there was a letter of intent by the current government, but President Lula issued a letter to the Brazilian people, essentially committing to a continuation of policies. Was that by itself enough? It certainly helped a lot, but we do not see the CDS spread come down to normal levels until almost a year after the new government, President Lula's government, was in office. And what really changed the market view was when President Lula appointed key personalities who had credible backgrounds, and they actually delivered on the commitments in the program. And so that's an episode of major market risk being priced in that was basically handled by borrowed credibility and then establishing credibility. Now, what are my lessons from that before I move to the second case? Domestic vulnerabilities really magnify shocks. The fact that you had massive, half of the debt was denominated in foreign currency and a floating exchange rate and a very volatile global environment, it created a huge vulnerability in the domestic economy. Now, over the years, they have managed to move away from that. Most of the debt is now domestic, and as you see, there is no shocks here. Secondly, domestic policy credibility matters. Yes, there were characters in charge. The Cardoso regime had huge credibility, but that was a credibility in one period by one government. But domestic credibility had to be established over successive governments of different color. And the third issue that I just put a question mark here, the central bank was not independent. Markets viewed Arminio Fraga at the time, and later his successor Mireles, as having credibility by themselves, but the central bank was not independent. And looking back on the case, I was wondering what would have happened to that CDS spread had the central bank been independent at the time, and say Arminio Fraga left with the Cardoso government, central bank governor left at the same time as the governor. What would have happened if the central bank had been independent and he had continued with a new government? We do have, now we don't know what the counterfactual would have been. As I said, there were enormous policy uncertainty and underlying vulnerabilities. But it is interesting, as you know, President Lula was elected for the third term recently. Central bank, interestingly, became independent in 2001, fully in law. And the central bank governor, prior to Mr. Lula getting his third mandate, president of the central bank, Neto, he stayed through the third term of President Lula, and the central bank independence, I think, was a safeguard there that comforted financial markets. So that's case number one from emerging markets. Let me go through the second case. Let me show you the chart first, and then I will describe the. Okay. I think, Olli, this is familiar to you, and I feel nervous talking about the Eurozone crisis because there are many in the room who are familiar with as much, if not more than me, with the circumstances. But I give you my personal perspective. Now, this is the Centix probability of breakup. It was put together during the Euro crisis. This is why you don't have data before 2010. But look at the peak there. The financial markets were estimating a close to 75%, 3/4% probability of Euro breakup. Now, I think all of us have our views at what caused that, and we all have memories of different episodes. But let me tell you what I saw as the height of that crisis. So, I think the height of the crisis was end 2011 to the middle of 2012. Interesting period. And what I remember, and Olli, you were there, you remember this well, probably to me the two most difficult periods of time where November 2011 symbolized very much at the rainy and stormy Cannes summit in November 2011, early November, and then the December Council, Euro Council, again a very difficult Euro Council when the fiscal compact was being discussed, and Italian spreads were at all-time high. And so the fear of Euro breakup was there. But let me just take you through some of the problems and how it was solved. At least, what I remember from that period. Interestingly, in November 2011, the Greek debt restructuring had already been agreed. It was finalized in October that year. It was the biggest debt restructuring in history at the time. It had a nominal haircut of more than 50%, 53% if you want to be exact, for the private investors, much, much higher than that in NPV value. And so our sense at the time was, well, debt sustainability was being restored, and therefore we should see stability in the markets. That's not how the market saw it. Why? Number one, because there was debt restructuring, and because, if you recall, some of the public holders of debt, particularly the ECB, were protected, there was a fear that the question being asked in the financial markets was, which country is next? At the same time, there was, and this is, I'll try and relate it to the topic of today, there was a major political shock. And so let me explain that. At the Cannes summit, the Greek Prime Minister, and everybody thought Greece should be in a very happy position because the debt restructuring had been agreed, but the Greek Prime Minister, facing domestic political pressure, said that he wanted to have a referendum on the new IMF European program that supported the debt restructuring. Political leaders at the time, you remember this, Olli? Political leaders, particularly Mrs. Merkel and Mr. Sarkozy, were not happy at the time, I should say the least. And they said, and they went public with this, and some of us fell out of chairs when they said this. They went public and said, if there is a referendum, it should not be on whether or not the Greek public supports the new program and the debt restructuring. It should be on whether or not they want to stay in the Eurozone. Hence the spike. And so the possibility for the first time of not just a debt restructuring within the Eurozone, within the EU framework, but the possibility of exit was put on the table. And that's what that reflects. Now, and the situation became even more complicated because at the November G20, it was not possible to reach an understanding with the new Italian government. And there were a lot of kind of international pressure that Europe was not able to respond at the time to come up with a plan to move forward. And above all, and I'll come back to this, this is most important for central banking, the markets questioned the availability of a lender of last resort in the Eurozone. And that included both for the sovereign and for the banking system. For the sovereign, because the view was, if, say, a country like Italy needed financial support to repay its debt, the IMF facilities and the newly created ESM together were insufficient. That was the market view. We disputed that, but that was the market view. And secondly, a huge wall of money was becoming due by the European banks to the financial markets in 2012. It's absolutely enormous. And at the same time, the banks had lost access to the financial markets. Wholesale funding in the financial markets was. So, how was this resolved? Obviously, it wasn't permanently resolved, but I think the 2014-15 episode is different. That is to do with the Tsipras government. So I think that's a particular episode. By then, the Eurozone was much worse. But how was it resolved? And as usual, there were a combination of political changes, economic reforms, and central bank action. I'll focus on the latter most, but let me just say some of the others. The Greek government didn't have a referendum at the end of the day. The government changed, and you had a technocratic government for at least a period. It provided stability. In Italy, there was a change in government also. Berlusconi left. You had Mario Monti with a technocratic government, helping with market credibility, implementation of policies, at least temporarily. But those by themselves were not enough. There was an issue of transparency in terms of, for example, the markets were super concerned that Italian policy was not strong enough. The Spanish banks were very weak. On the Italian side, it was decided that Italy would go into not a program, but intensive surveillance from the IMF and the Commission, and therefore have very, very detailed policy discussions and agreements and implementation. On the transparency side, it was decided to have the IMF come and have an independent look at the books of the Spanish banks, work out what the hole was in these banks, make that transparent, and then Europe provided the funding to address that. But what about the central bank? I think it's underappreciated that the LTROs, the credit operations that were done in December and in February of that period, December 2011 and February 2012, were incredibly important steps because the banks did not have access easily to the financial market. So they provided 3-year long-term funding at central bank rate, and that really eased, let me show you here, eased the concern about the bank sovereign doom loop. Is that, it will come, I assume. It's, oops. Yes, here. And here I'm showing an Italian bank, UniCredit, and Santander CDS spreads, that you see this doom loop. It reflected essentially the CDS and the spreads in the Italian and generally in the periphery. So I think that TLTRO was, or LTRO at the time, was 1 trillion of funding for the entire banking system. 3-year was incredibly important in stabilizing the situation, but by itself did not solve the problem. And what was the problem, remaining problem? I go back to the issue of the lender of last resort in Europe. Yes, the ECB was providing funding for the banks, and the banks were buying government bonds, but to the markets, this amplified the doom loop, the connection between the banks and the sovereigns. There were 2 important elements which enabled the ECB to do the major event. One was the fiscal compact being agreed among the European governments, which gave, while some of us were somewhat critical of some of the elements, they probably went overboard at the time, but nonetheless, it allowed a framework for fiscal consolidation and preventing fiscal problems in the future. And I think the second here, again, was a policy issue, was the banking union. Because by moving away the supervision from the individual authorities to the ECB, it provides a huge anchor of stability. And I think those enable the ECB to announce the famous OMT that stabilized the situation without spending €1. Why was the OMT effective? Because it was prepared to provide, and I think this is important in terms of the context of the lender of last resort, unlimited support to sovereigns purchasing their bonds. It was accompanied with conditionality, so it was not free money. And very importantly, from a market point of view, market was treated pari passu. So that also reassured markets. So I think those are the elements. Now, all of us remember the whatever it takes, but those were the elements that encapsulated that whatever it takes. It was substance behind it that stabilized the Eurozone. So I hope, Olli, was an accurate description of what we both went through. So let me conclude on this with sort of my conclusions of that. The lender of last resort function is of critical importance. Whether it's national or in the Eurozone, also cross-border, or whether it is international, and I would say the Fed dollar swap lines fall into that category. It's some form of liquidity lender of last resort. Second, I would say the ECB's very strong independence, legal independence, practical independence, was very important because in an environment of political difficulty, political shocks, differences of views, the ECB was able to act and the markets had an anchor of stability. And finally, central bank action, critical, but in isolation, it would have been unlikely, as we saw in some episodes like LTROs, was unlikely to work. You needed the policy background and the policy support on structural, fiscal, and political stability for it to work. So that's my second example. Do we have time for me to say a few words about the markets, and then happy to take any questions. So I think those are, now, with the third is not really a case. It's my reflections from the markets currently. And so we are going through a geopolitical shock at the moment. And I think it's too early for us to say how this would evolve and what policy action would be needed, how market reaction even would evolve. What we know so far about market reaction is uncertainty has been reduced. Uncertainty was at its highest in April 2. It has reduced particularly when it comes to the view of US markets. Things like VIX have come back to fairly normal levels. But I would say the broader policy uncertainty still remains. And that, if you look at several different indices of use. Now, some of the normality has returned. Here you see the stock market, US on the left, Europe on the right. The stock market has resumed its upward trend after the April 2. But if you just look at this chart, you see also there is something odd in the sense that we are used to exceptional performance by the US. Here you see the US performance on the left and several European countries on the right. And sort of European performance has actually been quite good when you consider, compare the two. And there are some European countries, like here I've shown the top one in green is the Spanish stock market. It's actually outperforming not just Europe, but it's outperforming US stock market performance. And it goes actually one step beyond that, because financial markets also look at the returns in total returns, not just sort of nominal returns. There is something happening in terms of the dollar, you may have noticed. So let me just say a few words on that. I think first of all, this chart, now some people show it's the relationship between the dollar index and 10-year treasury yield, and some people point out that there has been a divergence in the chart in recent times. It's one indication. In fact, if you plot this chart with interest differentials, you see the same thing. Something is happening which is unusual since April 2 in the financial markets. And the reaction function. And the reaction function is small. And here I have plotted, again, I hope I'm not accused of chart crime here, but I plotted different years from January to where we are, and the performance of the dollar index function, and you see sort of the red is currently. So this chart you can do in different ways. There are times where the dollar actually moves more than this and less than this if you don't do it by annual, but simply by annual, it's an interesting chart. So a key question is, what is behind this? And I think that has big implication for central banks for the rest of the world, particularly Europe. Why? Because the DXY, 58% of DXY is euro. And so euro movements would be most important. Other currencies are there, but the euro is by far the biggest, and the second is much lower down, Japanese yen or the sterling. So what explains this? I mean, let me put forward, and I think that explanation is important in terms of what's the implication for policy, particularly in Europe. I would say there are three factors that have contributed to this. Number one, the German fiscal package was incredibly important, sort of signifying the Europe preparedness to use fiscal policy for defense purposes. I think that did give euro a leg up and the dollar a leg down. The second is clearly differentials. As Mr. Jefferson indicated earlier, there is a reassessment of where policies will be, where the economies are, and therefore where monetary policy will go in the two different regions, with the ECB having done most of the job of achieving 2%, and the Fed, markets are reading the central bank as needing to do more. That's another reflection of it. And the third is a phenomenon which is new, and it is not easy to monitor, but it is very important, and that's hedging. So what we are seeing, at least in the markets, is that you do not have asset reallocations, but you do have hedging. And there were before the summer, there was an acceleration in the hedging by some regions, including some parts of Europe, Northern Europe. It came to a halt. It may start again. So that is going to be a key factor in terms of explaining what will happen. So I would say the execution of the fiscal plans in Europe, where interest rate differentials will go, and importantly, hedging going forward, are going to be key in terms of deciding where this will go, and therefore what it means for central banks and what they need to do about it when it comes to how it is incorporated in their growth and inflation forecast. So I think I'm almost within time, so maybe I stop here, and hand over to you.
Thank you, Reza. Extremely insightful talk, and I'm sure there are plenty of questions on the floor. Please.
Pentti Hakkarainen, photo review, the ECB. Thank you very much for your very good presentation. My question relates to the market and outlook. Public debt is quite high everywhere. Should we be concerned, and should the central banks be concerned our high level of public debt?
Yes, please. Go ahead.
If you're talking about the Europe or Eurozone, I think the markets do not have a particular view on what's the right level of debt. And when you look at across the industrial world, there are huge differences in terms of the level. The issue is really the ability to finance it. And there are two issues here. One, interest rate, and therefore the willingness of the financial markets to absorb it. And secondly, fiscal policy itself. Now, when I look at and fiscal policy, in that I take into account things like growth in the economy, particularly nominal growth generation in the economy. But in Europe in particular, there is a divergence in some of the key indicators that matter. For example, the amount of fiscal primary balance you need, and what the government is delivering, and the growth that goes with that. And for example, if you take the case of Italy or Spain, they are running a fiscal policy which is perfectly adequate, not just to stabilize debt, but to reduce it. So you see what is happening in the market. There's a compression of those spreads because market is, that's high. And then there are others, notably, for instance, France, where there's concern whether the primary surplus or balance going forward is adequate to stabilize debt. So I think the markets are more discerning by individuals, and they look at things like that, and, for instance, the average maturity of debt. So it is a more differentiated picture rather than just talking about Europe. Now, is there concern broadly, globally about debt? For sure. That's why you see steepening of the yield curve.
Thanks. We have time for one more question. Olli.
Thank you, Reza, very much for your excellent analysis of both the euro crisis and the recent market developments. That's very enlightening indeed. And maybe if I may just one comment concerning your crisis analysis, with which I, by and large, concur with. And I have to say that you brought some fascinating, if not traumatic memories with your analysis. And I would concur with you that the period from, say, October, November 2011 till September, October 2012 was the critical third rock bottom during the crisis. We had so many rock bottoms that you easily forget how many of those occurred. But especially the period from, say, May, June, during the Greek second elections of that year, until the outright monetary transactions decision in September 2012 was critical. And I recall quite vividly in May, June, when I talked with then Eurogroup President Jean-Claude Juncker, and we realized that the Greek elections will take place on the same weekend as the G20 summit in Mexico, on the western coast of Mexico. And what would that imply? It would imply that if you are on the western coast of Mexico, where I was supposed to go and represent the European Commission, you would have a 12-hour difference from Europe. And the election results would be known in the morning of Monday. So we decided with Jean-Claude that I'll stay in Brussels. I went to Musée Magritte to see Magritte's paintings during the day. Jean-Claude stayed in Luxembourg, and importantly, Mario Draghi stayed in Frankfurt. So we were ready in case that there would have been a havoc, a total turbulence in the markets. But fortunately, the elections went the other way around, and they provided some short-term stability at the time. But then we had finally a situation where the member state governments and the ECB got their act together during the summer of 2012. I just named the actions. One was the banking union, launch of the banking union. The second one was the Spanish rescue package of cajas, of the banks. And for once we overshot. We did overshoot by €1 billion, out of which 44 billion were used. And then Mario Draghi came with his famous words, we will do what it needs to save the euro within our mandate. And that led to the creation of the outright monetary transactions. So this comprehensive package was, in my view, quite critical. But it's very good that you remind us of the importance of the long-term refinancing operations, the LTROs, because they actually created ground for this so that the banking sector was able to stay above the surface, and we were able to break the doom loop between the sovereigns and banks. And that's why in the latest ECB strategy review, the LTROs are maintained as part of the toolbox, even though they are not, actively increased for the moment, because we don't have any need for that. So thank you very much for the analysis, with which I would broadly concur with. Thank you.
Thank you. Maybe just one final word. I think, like you, as I was preparing this, the memories coming back did affect my sleep. But one thing I do remember, I think, in this setting, I should say, obviously in those times of crisis, particularly at that period, the nerves were very strained, and there were a lot, Europe is a wide grouping. There were very excited people, but you could always count on reasonableness and calm of Olli to keep everybody on the right path.
Thank you, Reza, and join me to thank again Reza for excellent speech. So we have now 25 minutes for a coffee break, and we continue at 10 to 3, so 14:50 here. Thank you.
Dear governors, dear colleagues, dear friends, it's my pleasure to welcome you to this panel on monetary policy under uncertainty. The world is not predetermined. We always face uncertainties and must make choices. However, even if monetary policy decisions are always taken under uncertainty, some periods seem to be more trying than others. If we think back to the 1970s and the 80s oil shocks, the global financial crisis, the pandemic, or the brutal invasion by Russia of Ukraine, we are reminded that the unexpected can quickly overwhelm our models and the forecasts we rely on. As the saying goes, forecasts are always wrong, but still mostly useful. Today, the degree of uncertainty is again unusually high. Geopolitical tensions, shifts in the global trade pattern, and record high public debt levels cloud the near-term outlook. And longer-term forces, climate change, demographic developments, and rapid technological transformation, including the impact of artificial intelligence, all add further complexity to the environment in which central banks operate. Uncertainty challenges monetary policy in several ways. Forecasting was never easy, but it's especially difficult at turning points, precisely when policymakers most need clarity. The effects of monetary policy on inflation and the economy can vary depending on financial market conditions and behavioral responses. And communication becomes more demanding when the central bank can't provide precise predictions without creating false expectations. How should monetary policy respond? Here, economic theory gives us insights, but not a one-size-fits-all answer. Brainard famously argued already in the 1960s that uncertainty about the strength of transmission calls for caution. By contrast, research by Thedéen and others show that the uncertainty that concerns the persistence of inflation, stronger policy action may actually be warranted. Research on robust policy rules arrives often to the very same conclusion. What is clear is that the right response depends on the source and the form of uncertainty. That's why central banks have increasingly turned to tools such as scenario analysis, trying to prepare for not just the baseline, but for alternative paths the economy might take. Flexible and data-dependent strategies, as well as clear communication, are also essential. Recent strategy reviews, both at the ECB and the Fed, underline the importance of strengthening these practices. Of course, scenarios come with their own challenges, as one of our dear colleagues put it after the recent inflation surge. Our scenarios contained many possibilities, except the one that actually happened. To explore these issues, we are fortunate to have with us here three highly distinguished panelists. First, we have, on the right of me, we have Erik Thedéen, who was the governor of Sveriges Riksbank, or has been the governor of Sveriges Riksbank since 2023. So actually, Erik was the first non-Finn central bank governor in Sweden for 17 years. Before joining the bank, Erik was the Director General at the Swedish Financial Supervisory Authority, and he is currently also the Chairman of the Basel Committee of Banking Supervision. With the experience of steering the Riksbank in the turbulent period of high inflation, Erik brings us a Nordic perspective on how small open economies navigate under uncertainty. Next to Erik, we have Clare Lombardelli, Deputy Governor for Monetary Policy at the Bank of England. Clare has a distinguished career in the economic policy making, having served as the Chief Economic Advisor at the Treasury, as well as the Chief Economist at the OECD. So she has first-hand experience of the challenges of conducting monetary policy in highly uncertain environments. Interestingly, Clare also leads the bank's response to Bernanke review of the Bank of England's forecasting process. Last but certainly not least, we have Agnès Bénassy-Quéré, Deputy Governor of the Banque de France. Before taking up her current position, Agnès served as chief economist at the French Treasury, and she also has held several prominent academic posts. She's still currently on leave from her professorship at the Paris School of Economics. Agnès therefore brings a rare combination of deep academic expertise in international economics and hands-on policy experience, making her uniquely well-placed to reflect on how theory and practice meets in central banking. I very much look forward to hearing the panelists' views on how central banks can design and conduct monetary policy in the face of profound uncertainty, and how we can maintain credibility and effectiveness when the future is unknown, uncertain, and unpredictable. So after the few words, let's go straight to the business and start with a heavy two-folded question. As I said, uncertainty is always with us, but today's mix feels especially challenging. So first, do you see this period as unusually uncertain? And second, how should monetary policy respond? When can we afford looking through? When should we act preemptively? And so on. So, Erik, if you would like to.
No, it's a really good question where it's more uncertain. I remember standing on a press conference like a little bit less than a year ago in a small town in Falun in Sweden, where we had a meeting at the time. I said, actually now I'm sure it's more uncertain than it was last time. And then I came to the next press conference and said, what should I say now? so I tried to reflect on this uncertainty. And of course, if you look back, we have had 9/11, we had the Gulf War, we had the Cuba crisis. You could have so many episodes where you could say that the uncertainty was as high. But maybe the unique thing with this uncertainty is that we do have, and I've expressed this in different settings also in policy circles, that we have a military geopolitical threat from Russia, which brings a lot of operational, cyber, what have you, risks to stability and to inflation. And then we have a challenge of the whole economic order from the West. And the new administration in the US, when, tariffs, but maybe not only tariffs, but also, other parts of the economic system. And that combinations for the central bank maybe actually is enough to say that it's maybe is more uncertain than many other times. And of course, adding to this, that we have, compared to the Cuba crisis or whatever, a very, very complex, integrated, to a certain extent leveraged financial system, which of course makes the risks of any, let's say, accidents to stability maybe more severe now than it used to be. And so I will basically think I'd say that it is more uncertain. And also, just to kind of conclude on the financial stability side, we, I think, have a need to look into the pockets of increased leverage, where we don't have the transparency, basically non-bank finance part of the system. But do we have the willingness and the kind of political momentum to do that? I think that's a little bit of a question mark. So maybe we are kind of going into this without being able to actually prepare for it in a sound way.
Thanks. And Clare, your views on this?
Yeah, it's a good question. I mean, on the question of how uncertain are things now and how does that compare? I mean, they clearly are, right? We're clearly dealing with a very high level of uncertainty for all the reasons Erik says. But if you look at sort of the analysis and the data on uncertainty, it's a bit mixed, right? So if you ask people how uncertain they feel, you ask in surveys, whether that's businesses or individuals, you hear quite high levels of economic uncertainty being reported. However, if you look at financial markets and some of the volatility measures, actually they're not historically particularly high. We could talk about why that is. We could talk about whether or not we should take any comfort from that, particularly if you look at things like asset price valuations at the moment. You could question some of those. You can also do things like textual analysis. Again, that would suggest very high levels of uncertainty. Another way to look at it that we think about as central bankers is sort of model uncertainty and actually the accuracy of things like our forecasts and our analysis. And you can look at that. And actually what we're finding at the moment is certainly on the way down, if you like. Some of our forecasting has become more reliable than it was on the way up within inflation. But you have to look about that sort of medium and longer term looking further out, and whether or not, for example, you're seeing systematic biases on the direction of forecast errors, and does that give you a sense that maybe there are some underlying structural uncertainties to the economy? And I think maybe we'll come to talk about some of this later, but the question is not just are you uncertain about the cycle, but also are we uncertain about the trend and some of those drivers where we're seeing really big changes, some of the things you mentioned in your starting point, whether that's climate, demography, obviously the geopolitical changes that we're seeing. And that suggests that actually there's more fundamental questions around the structure of the economy that we need to think about. And that opens up questions about sort of model uncertainty and how we should think about modeling in that world.
Thanks. And then Agnès, the same for you.
Thank you, Tuomas. So perhaps let me start with a speech that Bénassy-Quéré gave in 2007, and distinguishing through three sources of uncertainty. The first one is on the state of the economy, second on the structure of the economy, and the third on expectations. So on the state of the economy, even in normal times, we have to rely on information on the flow, on variables, for instance, GDP or inflation that are later revised. On unobserved variables, we talked about the neutral rate. Governor Jefferson said a word on that. The output gap, the NERU, all this is unobserved. And we have to also to rely on other parts of the policy mix. The fiscal policy is also uncertain. As to the structure of the economy, we have uncertainty on the slope of the Phillips curve. We have uncertainty on the transmission of monetary policy, of course. And of course, with expectations, we know that expectations are anchored, but some research shows that experience of high inflation, for instance, may change the reaction of expectations to another shock. So we also need to be careful about that, and there is uncertainty on this. So let me take one example, which is the tariff shock for the euro area. First, uncertainty, what is the shock? So so now it has become less uncertain, but for a time, it was changing every day. So think about the staff trying to do the forecast, publishing the forecast, and then the next day, the tariffs are changed radically. So the source of the shock is already uncertain. And then, of course, the propagation, the impact on exports, the impact on inflation through the pass-through in the US, the pass-through in the EU area if there is retaliation, but also the reaction of the exchange rate, and then the consequences of the exchange rate on inflation and on output. So in April 2025, April this year, there was a survey made with experts in the private sector. They were asked what would be the impact of April 2 tariffs on inflation in the euro area. And there was a wide range of answers from negative to positive, even for the euro area. So I think we need to take this on board. Now, There's also a second distinction, which is between uncertainty and risk, Knightian risk. So the distinction is whether you can put probabilities on that or not. And the way central banks are navigating around these two, this distinction is to use things like confidence bands or fan charts for risks, so where you can have probability, and for Knightian uncertainty to more use, and I think we are going to discuss this later, scenarios, especially worst-case scenarios, to test the resilience of their policy stance vis-à-vis a scenario that would be different from the main scenario. Now, as Claire said, there are various measures of risk and uncertainty, and sometimes they diverge. So we need also to be careful about that. Market measures were diverging in 23, 24 from other measures based on text analysis or based on surveys. So this is also something that is a bit difficult to manage, for instance, and also because the popular measures of uncertainty are global measures, but sometimes the risk comes closer to the households and to the firms. Take the fiscal uncertainty today in France, which could have a sizable impact, for instance, on the savings rate.
No, well, certainly, as you described, the world is uncertain and even unpredictable, and so we don't know even from which probability distribution we should draw our probabilities. But let me just insist still on the issue that with my central banking 101, which is probably the first 20 years of working for the Bank of Finland, it was somehow clear that if we face a demand shock, we should act. If we face a supply shock, we should look whether we should be looking through. How in the current world, when we are facing a pandemic, the first year we analyze whether this is a demand shock or supply shock or when Russia illegally invades Ukraine. So how should we deal with this? When can we afford looking through and when should we be preemptive? We know that if the lesson from the global financial crisis was that if we were to approach the zero lower bound, we probably shouldn't be keeping our powder dry, but we should be acting preemptively. So how should central bank governor or deputy governor know what type of situation we are in? Easy one. Whoever you would like to.
Fine. Well, look, why don't I start on that? I mean, most of these shocks are a mix of both demand and supply, and I think you've sort of got to acknowledge that. But in terms of the balance, the sort of very classical view that you always look through, so you should look through certain sorts of supply shocks, I think has been challenged by the recent experience. And I think really it comes down to a key factor is, what is driving the shocks? And how permanent do you expect that to be? So some changes to supply. I mean, let's take at the moment. So for a lot of countries, a lot of commodities, food prices are quite high. Now, that's very different if that is because it is a one-off weather event that we don't expect to be continued, or if it is a result of a climate change or something else, which is a structural change to supply. How that will, the impact that will have on pricing, obviously, depends on the circumstances. Similarly, supply changes like demographics, I mean, it's not a shock. We can sort of see that coming. We understand it. But again, these are sort of structural changes that could have ongoing effects. The other sort of set of supply side things you have to think about is what if it is something which is temporary, but the effects might be more persistent? So Agnès talked about this question of where you have high inflation, and does that lead to a change in inflation expectations? There's lots of research now that shows that when inflation is higher, people are more attentive to it, and there might be thresholds at which people notice. Also, particular sorts of inflation have much bigger impact on people's expectations of inflation. So even if you have rises in inflation that might be temporary, there are reasons that you would want to respond to that if you think that there may be more persistence than otherwise. So it really depends on what is the nature of the change and what do you expect that to do over the monetary policy horizon, really.
Certainly, if I interpret you correctly, if it's temporary, it's easier to look through. If it's more permanent, then you should act even if it's a supply shock. The only thing is that when we are in the middle of things, also the length of the shock is uncertain. Like we saw when the war or energy crisis hit, we were rather long telling that this is temporary, and we looked through, but okay, let's not go into that. But okay, Erik, as a central bank governor of Riskbank, can you afford, well, one could say that, well, you act, you rely on the credibility of the inflation expectations and anchoring of inflation expectation, and if as long as that continues, you can look through. But can you really risk de-anchoring before you start?
No, I guess you can't, and I think this episode, the COVID or the inflation outbreak after COVID in 2022, for sure was a reminder that look-through is not always a good strategy. But it was also a very special case. I think two things. One was that we were preoccupied by low inflation. So it's kind of in the policymaker's mind and all the rest of the society as well. It was like inflation is always low. I think that you should not underestimate that force, actually, we've been living through so many years. And then we had the kind of dramatic surge in demand, which I think we actually underestimated, and demand in certain pockets as well, like service sector, right? So you should be a little bit careful to draw too many conclusions out of this, say that we should overreact in a way to all supply shocks. But structurally, I think supply shocks will probably come more often because of some of these, more structural things that you mentioned. Climate change may be the most important one, but also maybe geopolitical risk with, disruptions in food, in export and imports, and things like that. So you should be much more cautious, I think, when it comes to how you treat supply shocks. Having said that, we are, in my country now, looking through. We have inflation of 2.9%. We think it's temporary, so we actually lower rates because our inflation forecast is telling us it's going to be much lower. Next year, we will have a VAT tax cut and then a hike, they say, politicians, 2 years later. Of course, we will look through that. That would be ridiculous to say that we will lower rates because of a temporary VAT tax. So the concept of looking through is still there, but I totally agree with Clare. It's how persistent it is, how structural it is, if it says something of the kind of more overall economy, and hence I would be, I think the importance of climate change related events for sure is something that is new for the next 20 years, and maybe was not so important, let's say, for the last 20 years, and maybe then adding supply shocks that might come from, compare again with the low inflation environment where they have this big positive supply shock, you could argue, right, from labor force from China, increased foreign trade, internet revolution, what have you. Of course, some of that might actually be turning the other way around. Okay, AI might be something that could be a supply shock on the positive side, but trade disruptions, more of hostilities, let's say, between important trading partners.
Yeah, thanks. So, Agnès, Erik was hinting that the world was different after a decade at the zero lower bound, and one generation didn't understand what the concept of inflation was, because central banks had been so good in their business. Now everybody remembers what the inflation was, but still, I think the generation is thinking that we should return to normal, which is zero interest rates. How do you see in France, is there still a generation of people that really think that the normal thing is having interest rates at 0 and inflation at 1 or something?
So I haven't heard about it. I remember my students not so long ago when I was trying to explain inflation, they couldn't understand what I was talking about. And so I would look for a Latin American in the class and try and ask him or her to explain to the others. And it worked pretty well. Coming back to supply shocks, I agree that supply shocks are not all alike. Not just because some are permanent, some are temporary, and in between some are persistent, but not permanent. But also because the origin of the shock can differ. So there is a wide range of supply shocks. And for instance, one key distinction is between those that come from abroad compared to those that are internal. So an oil price shock or an increase in freight cost is a terms of trade shock. So it depresses aggregate demand, and hence it should have less impact on inflation than the same shock which comes from the inside, like a weather shock or a bottleneck somewhere in the services sector, for instance, or transportation. I think we need to make also this distinction. Also the shock, whether it's upstream or downstream in the value chain, will have a different impact. And also the research shows that if it's in a sector with flexible prices versus a sector with some more sticky prices, where you could have a persistent effect of the shock. So I think all this is quite well understood now. But my point here is to also have a look at the demand side of the supply shock. And coming back to uncertainty, uncertainty by itself depresses aggregate demand because it inflates savings rates. It could make the yield curve steeper. So this also needs to be taken into account.
So Clare, the Bank of England is a model central bank for us on approaching the public. That's at least how we think about the Bank of England. I'm not sure whether you feel the same, but in policy debates we often use unobservable concepts like output gap, neutral rate, natural rate, potential growth, NIR. Even today we have heard many times. Even the vice chair was asked his view on natural rate, and his answer was rather telling. I don't know where it lies. So do these frameworks genuinely improve decision making, or do they somehow complicate communication and risk alienating the public?
Yeah, I would distinguish between decision making and what helps and communication in a sense. So I think these sorts of concepts, these sort of structural variables, star variables, they're very helpful concepts. That as you're debating and discussing what to do with policy, it's important to think about them. Some people find them, in a sense, more useful than others. Some people are more certain about them or feel there are more certainty around them than others do. It's a lively debate we have across our committee. So I think they can be really useful kind of intellectual frameworks. You can also try and sort of track and observe the data against what you might think to help you try and understand the economy at the moment. So very helpful in sort of principle and as a thinking framework. In terms of communicating, I mean, this is, it's challenging for a central bank. You have multiple audiences and different layers of message that you want to send. And for some audiences, you want more nuance to explain much more detail. For other audiences, you don't. And some of the more theoretical and technical concepts you might not want to use in a conversation with the public about current level of inflation, direction, what you're doing about it. There are different layers of communication you would want for different levels of audience. There are some. I think you always want to be transparent and you always want to be clear about what your message is. Sometimes there is this question of sort of what level of detail and what level of nuance you want to get into when you're giving a sort of clear message. So I would say it very much depends on the audience. But things can still be incredibly valuable for policy making, even if you don't sort of lead your comms with them front and center.
Thanks. So, to what extent do you think that the central bank should weigh financial market volatility and asset prices when setting the monetary policy under uncertainty? Maybe also, how should one balance the inflation mandate with the financial stability concern? I know that in Sweden, there were, at least some years ago, there were big disputes whether central banks should be, in this sense, lean against the wind, or whether it should be a pure inflation matter. And there was a divide of views between the central bank and the financial stability authorities or the FSA. And well, you've been head of both. So what is your view now on this issue?
Especially was a lot of discussions within the board of directors at the time at the Riksbank. No, I think this is a extremely kind of disputed question. Researchers end up in different corners. I tend to take a little bit kind of the pragmatic view that you can't exclude a possibility where you might think of kind of weighing it in monetary policy, and how it's kind of phrased in our legal framework is that if so, you could lengthen your kind of, let's say, forecast horizon. So let's say you're worried of some kind of exuberance in the financial sector, you might have a little bit longer horizon and hence not kind of lowering rates too fast. What important, I think, changed in the last, let's say, 5 to 10 years is that the macroprudential framework, tools, decision-making, and here I've been very active myself personally in making these decisions, have been developed, I think, a lot. And that is a good thing, because that should be kind of the first line of defense. If monetary policy need to go very, very expansionary, you get asset prices going up, credit growth very, very strong, then you should have macroprudential policies. And you have the borrower base. We had compulsory amortization linked to LTVs, LTIs, similar to UK, although UK didn't link it to amortization. We also had the CCYB, the contracyclical buffer, which will not actually hinder credit growth, but it's actually a very good vehicle of increasing safeguards in the banking system. So I would rather prefer to continue to develop the macroprudential tools and, again, the decision-making, because there's always a risk of an inaction bias in all these tools, because they hurt. If you force amortization on households, it hurts. The household, you can maybe argue, but also hurts politicians who want to be re-elected, right? So there is a political economy around this, and it's also very hard, and I wouldn't advocate it, actually, to put all these borrower base into an independent central bank. I think that would be a dangerous step to take. So you need to have some kind of political involvement in it. So what I could see now, and I think that's true maybe of some other countries as well, that it's a little bit harder to convince people about the importance and relevance of macroprudential, given that the credit growth now is very low. Asset prices are not exploding any longer. But so I think the long answer to your short question is that you couldn't exclude that you weigh it into monetary policy, but very much the first line of defense is macroprudential, and I think we have increased our capabilities, in European context, a lot of discussions and knowledge shared in the ESRB, which I think is extremely valuable, and we should continue to do that.
Claire, if I understand correctly, you are a member of Monetary Policy Committee and the Financial Stability Committee. So for a male, that would be easy because we can think only on one issue at a time. But how can you combine the same? So basically the same question as to Erik.
Well, I mean, it's worth saying that in most cases they are mutually very reinforcing, right? Monetary stability contributes to financial stability, and financial stability contributes to monetary policy, and one supports the other. I agree very strongly there. Look, I think when it comes to areas where there may be a sense of competing objectives, you need to be very clear about, what are your mandates on each, and what are your sort of the governance around them, and you need to make sure those two. The people deciding on those two objectives have got clear communication. You also have different tools, and this is where I strongly agree that for financial stability you have one set of tools, and they're the right tools for financial stability. You have different tools for monetary policy. It's right to apply them in that way. And so I think that sort of clarity of sort of objective and around clarity around the tools is the way you sort of navigate through this. I mean, the other thing, it's just worth sort of pausing on, is, you're thinking about risks in different ways in those two worlds. So, in monetary policy, you're thinking really about what is the central case and what is the distribution of risks around that and uncertainties around that, and, what probabilities you put on that sort of baseline that you've got, what are the different scenarios you might have around it. For financial stability, you're thinking about risk in quite a different way, because you're much more thinking about tail risks and actually how robust is the system to those, and sort of testing and checking that. And so you might be thinking about scenarios in a very different way in financial stability.
So Erik was saying that if monetary policy needs to go to, let's say, extreme, the macroprudential policies can help in the sense that they can safeguard the financial stability even under those circumstances. So Agnès, you are from the Eurosystem. Could one think, continuing that line of thinking, that well, we have a common monetary policy, but as the macroprudential policies are national, so national macroprudential policies can, in a way, alleviate the problems if the common policy is not totally optimal for some, let's say, for example, some small country within the currency area.
Okay, so first, perhaps let me say that we have made the crash test with increase in the policy rate by 450 basis points in a very short period, and the financial sector was resilient. So I think we discussed previously the importance of independence of the central bank for its credibility and in order to disinflate with limited cost for the real economy. So to see this credibility as an asset that needs to be nurtured. And it's a bit of the same for financial stability. The ability of monetary policy to act forcefully relies on the fact that financial regulation and financial supervision are done correctly, and we've passed the test. I think we've passed the test. So we need to keep this in mind in the current discussions about deregulation. And of course, you get deregulation, you may have an increase maybe in credit and growth in the short term, and then at the end of, after a few years, you end up with a crisis. You have not improved long-term growth, and at the same time, you have reduced the ability of the central bank to act forcefully. So to come back to your precise question about heterogeneity across member states, I think this is a very good point, that macroprudential policy allows member states to adapt a little bit the stance of, say, the financial regulation along the cycle, depending on local specificities. I'm thinking especially of the mortgage market that may differ across countries. And this is very, very useful because it helps to weather a simultaneous change in the monetary policy in the different member states. I think this needs to be kept as it is, although, of course, the ESRB could also makes recommendations, and there is a top-up power of the ECB, which is something very useful too.
Okay, let me bring myself back more closely to the topic of this session, and which is monetary policy under uncertainty. So, Agnès, you earlier alluded to scenario analysis. So, do you think that how do you see, should monetary policy frameworks account for uncertainty more explicitly, for example, through scenario analysis or probabilistic forecasts or risk-based approaches?
Okay, so suppose that the economy is linear and suppose that the risks are balanced on the upside and on the downside. Then you could just discard uncertainty and look at your baseline scenario and decide on a monetary stance based on this scenario. Unfortunately, the economy is non-linear and the risks are not always balanced. So then you need to look at this. I think in the strategic review, ECB strategic review is what it was clearly mentioned that large shocks can have more than proportional impact on the economy. For instance, change inflation expectations. So how to account for the uncertainty? As I said previously, fan charts is a first step. It could give a false sense of scientific knowledge because it's based on past shocks, past correlation between the shocks, and it could miss a turning point. Then the sensitivity around the main projection is very useful to give orders of magnitude. For instance, in our case, what would be the relative impact of an additional appreciation of the euro versus an additional tariff in the US vis-à-vis European exporters. So to have orders of magnitude is useful. The problem, the limitation is you have no idea about the probability of different outcomes. So then at the end comes the scenario analysis, which is a complete narrative, an alternative narrative compared to the baseline scenario. So the idea is not to give a probability to it, but it is to test the robustness of the policy stance vis-à-vis an alternative scenario. So it's, in a sense, is to minimize the losses under an alternative scenario that could be very dramatic. So, for instance, there is an example in September 23 when there was a rate hike at the ECB, and it was explained as kind of insurance against a scenario where the disinflation would be stalling. So I think this is things that can be made to follow on what Claire was mentioning, not just in the policy making, but also in the communication, although it's quite difficult. Now, if you have multiple scenarios, many scenarios, then there is a risk that your baseline scenario is lost in the different scenarios, and that the markets concentrate on alternative scenarios, which is not the message you want to carry, especially publishing scenarios that were not really used in the decision making could bring the interpretation of the monetary policy decision to a wrong direction. So maybe we talk later about the communication. But,
So I guess you both want to add something because you have different styles of presenting your forecasts and scenario analysis. Yeah.
No, I think this is extremely important topic. So we used to have fan charts, and I'm not a fan of fan charts, and the reason being that's very, very hard to actually have a narrative to actually explain something. The only thing you could say is that, as this fan chart shows, the world is uncertain, and then it's kind of the next issue on the agenda, right? So I think scenarios is so much better because then you can have a narrative, and actually a narrative that could be not the most likely, but definitely not unlikely. So the last press conference, the last report we issued 2 weeks ago, or 1 week ago, was based. One was that we have a falling asset price markets, a turbulence in the financial markets that will depress demand. How would you react to monetary policy? I think it's a fairly good scenario, which is not unlikely. And then you could discuss around that. And of course, we had also one where we hiked rates. The problem, I think, and this would be interesting to hear from Clare and maybe from ECB as well, because we also publish a rate path. So, which is our main kind of forecast. Okay, extremely uncertain. But to me, it's a little bit hard to have scenarios if you don't have a main path, right? You have a scenario around a main path. So what we've done when it comes to the rate path is we used to have it a 3-year rate path. And we ended up in discussions, so I could see in your rate path that you were planning to lower rates here in 2.5 years' time. So no, we're not planning anything. It's kind of just an assumption. It's so far away into the future. So we basically shortened it when we made our policy kind of presentations to only 3 quarters ahead. And then I think made sense to actually have a discussion around such a rate path. Extremely uncertain, but still you could have a narrative around it. This is the assumption. We think inflation is coming down, growth is going that way. That's why we have this rate path. And then we have the scenarios around that. So I think that kind of combination works pretty well for us. However, I wouldn't overstate this, and I know scenarios is very kind of topical now in central bank community, and we have adopted them for some time, so we get a lot of questions, and we have discussed this, Clare and I, before. But in the end, the markets are not preoccupied by our scenarios. So I think that it's important, but it's maybe not that important, but it helps in the communication. And communication is extremely important.
So Clare, are you a fan of fan charts, or do you think the scenario analysis make policy communication clearer and more credible, or does it somehow risk confusing audience with too many possibilities?
Okay, let me start with fan charts. So fan charts, I think the Bank of England was quite early in its use of fan charts, and then we were lucky enough to have Dr. Bénassy come and do a review of our system, and one of his recommendations was to replace the fan chart. It is very interesting just how popular, there's a sort of a set of people who are very enthusiastic about the fan chart. They thought that was not a good recommendation, and they like it. It's very interesting. I think you have to sort of be clear on what a fan chart does tell you and what it doesn't tell you. So as Agnès says, it's based on past forecast errors, so it gives you some sense of within your model, within your forecast, if you look at the errors of the past and apply them going forward, it gives you a sense of uncertainty. And I think where it's possibly most valuable is it is a very powerful visual representation of that uncertainty. And so it communicates that message quite well. But you have to not overinterpret that, because actually what it's telling you is all based around one model and what's happened in the past. And of course, some of the uncertainties that we're talking about now are much wider than that, are much broader than that. And so it can give you a false sense of security in that sense. I think where scenarios, and I think scenarios should be one part of your toolkit. Right? There are clearly other things that are useful. The baseline forecast has a really important role to play, because it is your central expectation of what is going to happen. And you going through the process of putting it together, challenging yourselves, thinking about it, really does help you think about the relationships in the economy and the risks around it. So I think there's a really important role for that. It is a conditional forecast. So we condition ours on the market path. It's very, as the ECB does, perfectly reasonable and sensible thing to do. Markets have the same information that we have, and they process it. There's no reason to think we'd be better at processing that information. So we have a central path based around that. Now, there's other things you can do in the statistical space. So you can do the kind of statistical modeling. You can do the sort of growth at risk and apply that to other macro variables to give you a sense of uncertainty. And then there are scenarios, and I do think scenarios are a really useful tool for a number of reasons, and you can use them in different ways. So traditionally, or often they were used as sort of sensitivity analyses, like you say, you change a variable and you can see what would happen in your model. And so what if energy prices are higher? And you feed that through, and you can see what it does to inflation and growth. I think where scenarios can add much more nuance to that is they can, as you say, create a sort of a narrative and a story that fits together. So your topic for this conference, if you take geopolitics, right, sure, that will have an impact on, a geopolitical shock would very likely have an impact on energy prices, but it's also changing defense spending, and so fiscal policy. It might also have an effect on things like immigration and the labor supply. And so you can bring together things that you may see happening, at the same time, tell a story about them, and then test out what that would look like. And it allows you to do that in a more holistic way, I think, than a sensitivity analysis would do. The other thing that you can use scenarios for is where you're uncertain about the model or the structures of the economy. So you could use different models. You could construct your scenario on a different modeling basis to your main forecast, for example, and that would allow you to test different relationships. And so in all these ways, I think it allows you to understand uncertainty in a different way. And then when it comes to policy making, of course, there's a whole separate, we could have hours on robust policy making and actually how do you think about policies when you're in an uncertain place? What is sensible to do in one scenario and other scenarios and your baseline, and think about loss functions and all of that. But to your question about communication, I mean, again, it sort of depends they can be very powerful for communication because they allow you to tell a story as to how the economy may be different. And I think that can really communicate uncertainty, not just a picture that the bands are wide, like a fan chart, but actually why might things be the way they are and what could be the underlying drivers and explanations of that. So I think they do have an important role on communication, and that was one of the reasons that Dr. Bénassy suggested them to us as a method by which you can explain uncertainty and you can make uncertainty more real to people than some of these more sort of abstract concepts of uncertainty are.
Yeah, before moving on, I just want to make one comment on Erik. You said that there's a difference because Bank of England and the ECB, we take the market rate path, whereas you have the policy path. I don't think that is the main difference because, well, we forecast what the inflation would be with the market rates, and you fix the target inflation at the end and forecast what rate path would be needed for that. I don't think that is the biggest difference in your and our forecast, but it's rather than your rate path is set or it is underwritten, signed by the Riskbank board, whereas at the ECB governing council doesn't. It's not the governing council forecast. It is the staff forecast, and it's only one input into the policy making. So I guess that in your case, it is taken a bit more seriously, even though there should be the very big grain of salt.
So this is definitely a difference, but as we kind of make up our own rate path and not totally buy into the market, sometimes it's very similar, but not all. It's also a very important signaling tool, right? And that could be, sometimes a negative thing because it's hard to signal, and maybe people misinterpret the signaling. But we think it's important to have the signaling. What is our best guess judgment on the next steps and the reason behind it. So we could have let's say, a narrative of our future monetary policy based on that interest rate path. So for example, if I get a question, is there likely with a rate cut in the next half year, I could say, well, it's extremely uncertain, but if you look on our rate path, it's a 50-50% chance. This is an example, so that's not where we are now. So it creates a framework, let's say, to communicate about future policy, and we don't need to say as the only answer that we are data dependent. I think that is a good thing, but I totally respect that this could be different in different kind of setups and jurisdictions. And we are a small board, we have 5 people. In the ECB and the Fed, there's so many more, so that might also complicate the whole forward guidance issue.
Yeah, okay, continuing on communication. So in an environment of heightened uncertainty, do you think that can forward guidance, the ultimate communication tool, can it play any role, or should we just lean more on data dependence, flexibility, and some type of expectation management? Anyone?
So I think when there is a lot of uncertainty, the key is to communicate on the reaction function. And I think this is the idea behind the 3-pillar communication of the ECB with incoming data, the transmission of monetary policy, and of course the outlook concerning inflation. So I think this type of communications, the objective is to communicate to the market how will the ECB in the future react to the news. And at the Banque de France, one researcher has regressed expected interest rates on expected inflation. And what is remarkable is that for the euro area, you find that the coefficient on expected inflation is higher than unity, which is what you expect to anchor the inflation. You want the coefficient to be higher than unity, hence the real interest rate to increase when there is higher inflation. So it's higher, it's well higher than unity for different horizons, except during the period of effective lower bound, which makes sense. So to the extent, I think to the extent that these coefficients are well anchored above unity, I think we are safe in terms of communication, despite the fact that there's huge uncertainty.
So can you continue, Agnes, on how can we, as central bankers, acknowledge the limits of our knowledge and understanding and the range of possible outcomes without undermining confidence in our policies?
Well, you could say the opposite. Think about a central banker coming to a press conference and say, I know it all. Trust me, this is where... so this is not credible. So I think everybody understands that central bankers are facing some uncertainty. They don't know everything, so they try to navigate in this uncertainty with the different tools we've been discussing. I think also that their role is to reduce the uncertainty, and in that sense, it's a kind of a paradox that in recent months, inflation has been correctly forecasted. So it seems to, if you just look at the forecast errors concerning inflation, you have the impression that there is no uncertainty any longer, which of course is not the case. So I think in this particular period, the central banks contribute to reduce uncertainty. Well, I don't know how long this will continue, but so far, so good.
I think it's interesting how you can learn from other disciplines. So there's quite a lot of evidence that shows actually people can cope with things being complicated if they are explained to them. There's lots of evidence if you look at, for example, during the sort of statistical profession and COVID, actually how that was explained. Actually, there's quite a lot of evidence when you look at that as to how members of the public actually could understand that information incredibly well. It was clearly and simply explained, but, you know, it was complicated techniques. So I agree with Agnès that it would be credibility damaging to claim there is more certainty than there is. Really, the trick is to explain what is uncertain, explain why, and explain why the policy that you are adopting is sensible in the face of that uncertainty.
Yeah, about certainty or uncertainty, normally when you have three economists sitting on the sofa, you have at least 4 different opinions there. I can remember only one occasion when all economists were certain on something, and it was this January, everybody was certain that if US comes with high tariffs, US dollar will appreciate. Okay. But then...
other things equal.
Yeah. So I'm not sure whether Juha is showing 1 or 0 minutes, but well, 0, well, I think we need to give room for the president. So but let me just conclude that Agnès, you were hinting that the world is not a linear one. So I would say that fortunately the world is unpredictable and non-linear, because if it wasn't, nobody needed us. Yeah. Okay. Thank you.
Conclusion.
Thank you.
Thank you.
Go on stage now. Yeah. Okay.
Do we have a sight of the president for the moment? Very good. So, Tuomas and Erik and Clare and Agnès were very punctual and finished in time. Thanks very much for the excellent panel discussion. And in fact, when I was listening to the panel discussion, I reflected that it is very refreshing to have a panel discussion and a conference where you don't have an oversupply of 1,000 words, 1,000 times hearing the words artificial intelligence and stable coins and cryptos. There are other things in the world to discuss as well. But our next speaker does not require any introduction, but I want to do it anyway. President Christine Lagarde, dear Christine, I won't go through her entire CV, but let me pick a few, say 3 factual elements combining both official and some less known elements. Nothing dangerous though, Christine, so don't worry. Christine Lagarde has been the president of the European Central Bank since November 2019. Prior to that, she served as MD, or Managing Director of the International Monetary Fund from the summer of 2011 until October 2019. And before that, she held different ministerial posts in France, especially the Minister of Finance between 2007 and 2011. But prior to that, Christine Lagarde was the global chair of Baker McKenzie, based in Chicago. And I must say that you have to be a tough cookie to lead a Chicago law firm, at least if you watch Suits and are a fan of Harvey Spencer. And it's quite evident that leading the European Central Bank and its governing council is simply a piece of cake compared to leading a Chicago law firm in the US. Another fact is that Christine Lagarde has a special interest from her youth already, and she has competed in this, that is synchronized swimming, which I believe is a sound foundation to lead the orchestra of the governing council in terms of monetary policy and central banking as well. And furthermore, Christine Lagarde has her first, and this is rarely known, I think, has her first, to my knowledge, your first college degree is in the American literature. And that must be immensely helpful in both designing, doing, and nuancing communication, which is so crucial. Communication is so crucial in making monetary policy as well. And that must be a major asset, even though in these days you can say that modern American literature is rather based on capital letters and acclamation marks. I don't refer to any tweets, don't worry. The title of the keynote speech of President Christine Lagarde is Trade Wars and Central Banks Lessons from 2025. So please join me welcoming Christine Lagarde. Christine, the floor is yours.
Well, good afternoon to all of you, and it really takes a professional football player to introduce a semi-professional synchronized swimmer. So thank you so much, Olli, in the country of ice hockey, where you excel at very continental European sports, UK included, actually. So it's very nice to be back in Finland and to be back in Helsinki. And here in Finland, the idea that economics cannot be separated from geopolitics is hardly new. During the 1990s, as the Soviet Union collapsed, Finland lost more than 10% of its GDP when trade with its eastern neighbor suddenly evaporated. And few countries know better the cost of ignoring geopolitical realities. Today, the rest of Europe is facing a similar reckoning. We find ourselves in a new world, one where policymakers can no longer confine themselves to traditional economics and financial variables, however talented the economists who practice those are. Now we must factor geoeconomics into our analysis. The term geoeconomics was coined in the 1990s by Edward Luttwak, who described geoeconomics as, I quote, the admixture of the logic of conflict with the methods of commerce. So it is not protectionism in the old sense of sheltering vulnerable industries. Instead, it is trade deployed as a tool of power, a strategy of influence and dominance. This approach has been around for some time, most visibly during the US-China trade disputes that unfolded during the first Trump administration. The unjustifiable war in Ukraine and the sanctions that followed have also reshaped the European landscape. But 2025 marks the first year in which Europe itself is on the receiving end. We currently face the highest tariffs since the day of smooth Olli in the 1930s, imposed by our largest trading partner. Global trade is being reshaped as other countries respond to tariffs directed at them. And in the span of just a few months, we have seen a surge in trade uncertainty and sharp swings in exchange rates. So, now is a good time, and here is a good place to take stock of what we have learned so far and what that implies for monetary policy. So let me comment on expectations versus reality in relation to the trade wars. Close your eyes, go back 1 year. Most of you would have assumed that US tariffs rising from 1.5% to 13% would trigger a major adverse shock to the euro area economy. And indeed, most trade models judged the imposition of tariffs to be on net negative for euro area growth and likely positive for inflation, at least in the short run. This was broadly our internal assessment in December of last year. Although we pondered that with a high level of uncertainty. 3 channels were usually seen as decisive in producing such an outcome: retaliation, exchange rate, uncertainty. First, retaliation. Well, reciprocal tariffs were expected to raise import costs and reverberate through supply chains. And in most models, this retaliation channel was by far the largest driver of higher short-term inflation. Second, the exchange rate. Tariffs were expected to trigger a depreciation of the euro against the dollar, driven by expectations of higher US rates and a smaller US trade deficit, thereby amplifying imported inflation. Third uncertainty, elevated trade policy uncertainty, was expected to weigh heavily on business investment and growth, often more than the direct effect of tariffs on exports themselves. And this was expected to be the largest negative force on growth. Well, as you can imagine, some of these assumptions have not been borne out. And this is because the tariffs were not isolated in and of themselves. They were a symptom of a broader geopolitical shift, one that triggered political economy dynamics beyond the reach of our standard models. Let's go back and start with retaliation. In Europe and globally in the main, it has so far been very limited. In response to the US tariffs on steel and aluminium, the European Union announced counter tariffs on around 26 billion worth of American goods. But the European Union suspended them once a deal was struck in July. They were never enforced. Pressure from major industrial groups to avoid a prolonged cycle of tit-for-tat measures, as well as concerns about jeopardizing US support for the war in Ukraine, ultimately outweigh pure economic calculus. As a result, we have not yet seen significant supply chain disruption. Global supply chain pressures remain contained, and in the euro area, bottleneck indicators are close to historical average. And if anything, rather than blocked supply chain, the euro area is facing rising imports. The EU trade deficit with China has risen by around 10% this year, although this was driven mainly by weaker Chinese demand than by diverted trade flows that, of course, are under close scrutiny. That's for retaliation. The exchange rate does not behave as expected. Rather than depreciating, the euro has appreciated substantially. And since the start of this year, it has risen by anywhere between 12 and 13%, depending on the day when you actually measure, against the US dollar, while the nominal effective exchange rate has increased by 6% and the real effective exchange rate by 5%. And this reflects the fact that the imposition of US tariffs coincided with a broader re-evaluation of the country's position in the global financial system. Investors began to question whether the US dollar would continue to warrant its status as the ultimate safe haven currency. Another political economy factor that narrow, tariff-focused models excluded by assumption. The international role of the euro has helped insulate us from the resulting exchange rate volatility, with 52% of our imports invoiced in our own currency. But of course, many key imports, particularly of commodities, are still priced in dollars. The euro's appreciation has therefore contained imported inflation from supply chains, while at the same time placing an additional drag on growth. So the third one is the effect of uncertainty. The effects have been more in line with our expectations. The expected cumulative impact of tariffs and uncertainty on growth is around 0.7 percentage points between 25 and 27, compared with our projections last December. Still, these effects have not been as strong as we had anticipated. For example, only about a quarter of the downward revision for next year, compared with December last year, is due to uncertainty. And this is partly because trade policy uncertainty fell faster than we expected as soon as the deal with the United States was concluded. It is also because the euro area has taken internal measures to boost growth that have helped counter external weakness. And in particular, governments in Europe have committed to the largest increase in rearmament in decades, with some reversing years of massive underinvestment. Government investment is now expected to add 0.25 percentage points to growth between 25 and 27, offsetting around 1/3 of the trade shock. The European Union has also pushed ahead with new trade agreements, which will support growth. The Mercosur and Mexico deals now being adopted cover more than 3% of extra euro area goods exports, while agreements currently under negotiations account for a further 6%. And I'm here referring to India, Indonesia, and the Philippines. So this is another example of a response that models could not capture beforehand. Trade pressures have led European governments to reevaluate their broader trade and security relationships around the world. And that has prompted an endogenous investment response. So all in all, with no retaliation, an appreciation of the exchange rate of the euro, tariffs have had little inflationary impact so far, with their adverse effects mainly limited to growth. And those effects, however, have been relatively modest thanks to the domestic response. So in an environment of high uncertainty, understanding the nature of shocks is a precondition for getting the baseline protection right. We heard lots of wonderful comments about this particular analysis of what is exactly the nature of the shock. But capturing the balance of risk is just as crucial, so that we are prepared for a situation in which the baseline may prove obsolete and can, as a result, act preemptively if necessary. And this was, as Olli Rehn described for you this morning during his remarks, one of the key conclusions of our recent strategy review, to emphasize more risks and uncertainty in our decision and not just rely on our central projections. Not to say that we will publish scenarios all the time, no, but we will certainly use them to try to balance those risks and measure them as accurately as we can. So initially, we viewed the risks to growth from US tariffs as tilted to the downside. This assessment was informed by extensive scenario analysis, including escalation scenarios and possible offsetting forces, notably the growth impact of a sustained increase in defense and infrastructure spending. And overall, these scenarios have consistently shown that the most salient risks, those that could push growth furthest from its current path, lie on the downside rather than the upside. For example, ECB staff found that severe escalation in trade tensions could lower growth cumulatively by about 1 percentage point over the projection horizon. The potential boost from higher defense spending would offset, but would not be sufficient to offset this, even if all countries were to deliver fully on their NATO commitments. Now, this tilt in the risk balance remains roughly in place today. But at our last monetary policy meeting, we judged risks to growth to be more balanced. And we did so because the likelihood of major tariff-related downside risks materializing has fallen owing to the new trade deal that was concluded and materialized in August. Now, meanwhile, we initially judged inflation risks to be two-sided, with plausible scenarios that could push inflation off track in either direction. But as new information has come in, the range of risks on both sides has also narrowed. In particular, the absence of significant EU retaliation has reduced the risk that higher import tariffs might drive inflation above the baseline. Our scenario analysis also points to inflation risks that remain well contained. If trade tensions were to reignite, staff project only moderately lower inflation in 2027, which is currently the last year of our projection horizon. Higher spending on defense equipment, by contrast, would only modestly raise inflation, given its relatively small weight in the consumption basket. Staff have also examined scenarios that would affect prices more directly. So on the downside, Chinese export prices being lowered further as a strategic response to tariff. And on the upside, more pronounced bottlenecks in global supply chains. In both cases, however, the impact would be limited under reasonable assumptions, with inflation in 2027 differing by only 0.1 to 0.2 percentage point. So what does that imply for our monetary policy? I have said, and many of my colleagues on the Governing Council have also said and repeated, that we are in a good place. And this was largely a reference to the fading of the large inflation shock we faced in recent years, which is now essentially over in the euro area. But there are also, I said largely a reference, but not only. There are also three additional reasons why it applies for the current situation. First, because trade shocks are not creating new inflationary pressure. We are not confronted with the classic policy trade-off where the central bank faces stalling growth and rising inflation. This has already allowed us to cut policy rate by 100 basis points since December, cushioning the impact while keeping medium-term inflation on track. Second, insofar as we can model the future, the risks to inflation appear quite contained in both directions. And third, with policy rate now at 2%, we are well placed to respond if the risks to inflation were to shift or if new shocks emerge that threaten our target. At the same time, we all know that we are navigating a far more difficult environment than before, beset by war, tariffs, and uncertainty, which we must also factor into our policy. If we consider the known knowns, the risks appear well bounded. But if we consider the known unknowns, above all, how euro area companies will adapt in this new setting, firms are still running down inventories and absorbing the shock, part of the shock, in their margins, so the full effect of US tariffs have yet to become clear. And finally, there are the unknown unknowns. In a world of geoeconomic trouble, new trade and geopolitical shocks will remain a constant feature of our environment, as Erik was saying in the previous panel. How these forces play out will have unavoidable effects on monetary policy, not only through their impact on growth, but also on potential growth. If firms interpret the new environment as a lasting confidence shock, we could see investment shift out of the euro area. Where to is a question. Preliminary staff analysis suggests that all else equal, tariffs are likely to weigh negatively on potential growth. Lower potential growth would in turn put downward pressure on real rates and reduce the policy space available. But this is not the only path. Other paths are possible if governments act decisively and give firms new reasons to be confident. There's a lot of pressure currently on some of our authorities when it comes to delivering of some of the prescriptions identified by Draghi, Leeper, and a few others. And while things are not moving as fast as we would all like, things are moving. One factor often overlooked in the tariff debate is that our internal market is far more important for trade than the global market. Staff analysis at the ECB shows that an increase of just 2% of intra-euro area trade would be enough to offset the loss of exports to the United States caused by higher tariffs. This is a compelling reason to implement the reforms that I just mentioned earlier, particularly simplifying burdensome regulation, completing the single market, and building a genuine European capital market. The same reforms would also help European companies adopt, I'm sorry, Olli, artificial intelligence more rapidly. This would result in a positive shock for potential growth, helping to balance the negative forces coming from abroad. In short, nothing about our future is fate, and there is no room for complacency by any party. But for our part, as European Central Bank, we cannot pre-commit to any future rate path, whether one of action or inaction. And we will, and we must remain agile and ready to respond to the data as they come in. So I can assure you that this is currently a pretty unusual time to be a policymaker in monetary matters. We do have wonderful economists, and they do try their best, but even the best of the best occasionally acknowledge that they have to be humble and that we simply don't know. But we can take comfort in having overcome a large inflation shock after the pandemic and in how the economy has coped so far with an upheaval in trade relations. As Agnès was saying, it was a bit of a crash test, and so far, passing. But we must remain alert to the possibility that not all the consequences are visible today, and that the new shocks may still lie ahead. So as we look into the future, we do so mindful of Finland's long tradition of sisu, courage and inner strength in the face of uncertainty. Sisu is not a show of fleeting bravery, but rather a fierce determination and perseverance to continue fighting, even when the going gets tough. We're in a good place today, but that place is not fixed forever. Our task is to sustain it with agility, humility, and a firm grounding in the data. I thank you very much. What do you want me to do? Sit or?
Maybe you can stay there.
Okay.
So thank you very much, Madame Lagarde. I understood that you would be ready to take a few questions from the audience.
I said two or three.
2 or 3?
Okay.
So who wants to be the number one? Okay.
Thank you, President Lagarde, for a clear and excellent exposition of geoeconomics and European policy. Because you didn't mention enough things, so the US, there was a reference to the trade war, so forth, the Draghi report, the Leto report, many things. But one thing that you did not mention, and I was wondering about, is how do you see the European economy, European policy in response to the rise of China? There was an article by David Atour in the New York Times about the China Shock 2.0, where the rise of China's morphing into high-value exports such as electric vehicles, batteries, so forth, areas that Europe used to be or is quite dominant in. Do you see that this is a challenge or an opportunity for Europe, and how does that factor into the geoeconomic set of risks that you talked about? Thank you.
I have to divorce myself from the trade minister that I was once and only look at it with my current function as president of the ECB. And of course, we are monitoring the volume of import, volume of exports, the risk of rerouting, the risk of redirecting. And this is, the development of those factors would obviously have an impact on our prices, on our competitive position, and all of that matters a lot. Now, there was a lot of assumption that the trade that would otherwise have been directed from China to the United States would be redirected, not rerouted, redirected to Europe. We haven't seen much of that, but of course it is something that we have to monitor. I think the authorities outside our monetary remit, the Commission, the trade authorities in China have a dialogue that is ongoing, which is particularly focused on this risk of redirecting. There is rerouting in play. That is definitely something that you can actually measure. You can analyze the flow of goods coming from one supplier to the ultimate receiving countries, and the number of steps along the way is different from what it was a year ago. So we're looking at all that to measure and determine the role that it would have in terms of prices and the impact it would have on inflation. But so far, it is not what we had sort of instantly feared. But everything in monetary policy and such developments have a lag time about it, and rerouting or reorganizing supply chains take quite a while. So watching, not conclusive in any direction at the moment.
Thank you. More questions? There, and please state your name and the organization. Thank you.
Elisa Newby from Bank of Finland. In Brussels...
Thank you for your hospitality.
Thank you so much, Madame Lagarde, for this excellent speech that gave lots of food for thought. It was recently reported in Brussels that only about 10–11% of the Mario Draghi's recommended reforms have been kind of completed or even taken on the board. So my question is that what could the Eurosystem, ECB, do to encourage and speed up the process of reform so that the competitiveness of the European Union would be improved? Thank you.
Thank you for a really relevant, pertinent question, and one that makes me suffer, I have to tell you. I think we Europeans, and I'm speaking under the control of a former commissioner, Olli, Rehn, we have to come to terms with the fact that change is taking place at a much faster pace than what it used to be 20 years ago. And I think that the speed at which we examine legislation or propose legislation, the speed at which political leaders organize themselves, needs to be significantly accelerated. I'll share one frustration. I don't want to comment too much because, number one, we have not conducted this exercise to conclude that only 11% has been already implemented. We know that there is a lot in the making and in the works, and I can see for myself that there is momentum. I have attended enough European councils to know that around the table and with the Commission there is definitely a momentum. But we are victim of our own legacies and complications and this democratic process that we praise ourselves with, and rightly so, but which is operating as too much of a drag at a time when speed is really of the essence. I'll share one frustration with you. When I started back 6 years ago, I was adamant to push for the digital euro and to make sure that we would be digitally anchored with central bank money. Given the time that it takes, and this is currently pending before the European Parliament, given the time that it takes, I will be gone. In other words, my mandate will have expired when the digital euro is eventually launched for good. This is too long. It takes time. When you want to launch something, it has to be right. And the same applies for securitization, for capital market union, for banking union, and what have you. But we just have to accelerate. So my plea is for an understanding of the speed at which reforms have to take place and change has to occur. Because we don't want to be left in the dust. I don't.
Thank you. So it was 1, 2, 3
Sorry
questions.
if I'm a bit extreme, but I'm really passionate about this.
So I think we have time for one quick question still. See any hands here? Okay, then thank you very much, Madame Lagarde.
Thank you to you.
Thank you.
Thank you so much.
Okay, thank you, Madam Lagarde, again, and everybody for excellent speeches so far. So we are approaching the end of the sessions at the moment. And last but definitely not least, I have a great pleasure to invite soon on the floor Erik Leeper, the Paul Goodlawyer McIntyre Professor in Economics at the University of Virginia, the position he started in 2018. Just a few words about Erik before letting him on the floor. So Erik is a research associate at the National Bureau of Economic Research, director of the Virginia Center of Economic Policy at the University of Virginia, an external advisor to the Swedish Central Bank, and a member of the Research Council of the Bundesbank. Prior to joining the faculty at Virginia, Erik spent 23 years at the Indiana University and 8 years in the Federal Reserve System. Certainly many of you know Erik's research, but he focuses on theoretical and empirical models of macroeconomic policy, with a special emphasis on extremely timely topic on monetary fiscal policy interactions and fiscal theory of price level. And his most recent work examines on the economic impacts of government spending, the macroeconomic consequences of alternative resolutions to long-run fiscal imbalances, and the modeling of fiscal limit and sovereign risk. As you can see, his title today is Fiscal Foundations of Inflation, Seeing Beyond the Monetary Narrative. So Erik, the floor is yours.
Thank you very much. It's a pleasure to be in Helsinki for my first time. One correction is, since Erik is here, I don't want to claim that I'm still an external advisor to the Riksbank. That ended some years ago. So this title is a book that I'm in the process of writing, and I decided to write this book after, in my capacity at Mercatus Center, I spent a lot of time on Capitol Hill talking to staff. And what I recognized was that these are smart people. They're not economists. There are smart people who aren't economists. And they're not technically oriented. And they're very busy. But they have a hunger for trying to understand what generates inflation and how do you cure it. And in particular, because they're on Capitol Hill, they want to understand what is the role that fiscal policy plays in this. And so the goal of this book is to write to them. So it's a non-technical book. It's all based on sort of cutting-edge research, and there's a lot of data. Nothing formal, just a lot of pictures. And so what I'm going to do today is provide an overview of the themes that are reflected in the title. So this might at times seem a bit US-centric. I don't think it is. I think the US might be ahead of the curve when it comes to fiscal dominance. I feel pretty sure that we've been there at least since COVID. But there are a bunch of slow-moving variables that are at work across most of our countries. And I think these things all tend to push us in one direction, and that is away from the status quo, which is monetary policy controls inflation, fiscal policy just takes care of itself. Aging populations, declining population growth, we all know about those things. Increasing polarization, we see that across all of our countries. A rise in populism, we know the quality of economic policy that tends to come out of populist governments. And this was something that occurred to me this morning, or earlier today, that I was going to raise, but there's this growing distrust in government institutions. So when a central bank talks about wanting to anchor expectations, that relies on trust in that organization. And because we're losing trust across all of our institutions, it isn't going to be long before that starts to affect central banks as well. And then expanding income inequality. So what fiscal dominance does is it strips away from the central bank any ability to operate independently. And so this then raises a question about whether the historic norm, I call it the Hamilton norm after Alexander Hamilton, that fiscal policy takes care of itself, or if we want to be biblical, that deficits beget surpluses, whether that's going to be sustained. So the nature of this talk is, it's like a blues song. It's going to be call and response, you know. My baby done left me. Da, 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 da. So I'm going to present a proposition that I say comes from the monetary narrative. And that's the call, and then I'm going to offer counterexamples or counter-arguments. And so taken together, these propositions comprise the full monetary narrative that I think we all read in the Wall Street Journal or the Financial Times. So first thing is, what do I mean by inflation? Well, I mean sustained periods where inflation is above target. I don't mean temporary fluctuations, all right? And what I'm going to do is I'm going to sprinkle in some empirical evidence. All of it's going to be informal. This is the mother of all monetary doctrine propositions. Inflation is always and everywhere a monetary phenomenon. Well, where does this come from? First of all, there's some notion of money that's special. Now, it was based in thinking about transactions, purchases of goods and services, a narrow set of the kinds of financial transactions that actually take place. And the monetarists were always kind of slippery about what is money. And the argument for their choice of money was really about empirical regularities. It wasn't a theoretical point. But this was the beginning of what I call go-it-alone monetary policy view of inflation control. And in this environment, you know, it's what you teach your undergraduates. You look at the money market, I guess supply is vertical. Supply is vertical. Demand. Okay, this is demand for you, right? It's supply for me. So, you know, it's all about the price level comes out of that intersection. And you don't talk about any other assets. Okay, so as I said, the specialness of money was really about stability of money demand or velocity. The choice of monetary aggregate, M2, where did that come from? Well, gosh, it seemed to be consistently correlated with inflation. So then the question is, what is money? Should it include all government liabilities? I mean, M2 is almost entirely produced by the private sector. Why would you choose M2 as your object to consider for policy when monetary policy has very little control over it? And if this is just looking at the US data, but you know, if you look at total government liabilities, it's almost entirely Treasury securities. My point is going to be that all of these are government liabilities. They're all backed by the same thing, which is primary surpluses. So I don't understand how you could ever think that inflation depends on only a subset of these liabilities. And yet, if you read Arthur Laffer in the Wall Street Journal, he has predicted hyperinflation twice in the last decade. All because bank reserves have been growing rapidly, forgetting, of course, that if you pay banks to hold something, that they will do it. Okay, so I want to think about this in an accounting way, that you have government liabilities and you have the assets that back them. Now, the liabilities are primarily, here is, you're going to see my US-centric view here. They're just promises to pay dollars, right? They're not promises to pay purchasing power. There are some index bonds, but in the United States, it's a small fraction. There are more in the UK. But primarily, it's not a promise to pay in gold or anything else, right? So those things are nominal. What are the assets that back them? Well, they're primary surpluses. Again, to the extent that tax codes are indexed to inflation, as well as many expenditures, for example, a lot of old age benefits, medical benefits are automatically indexed, those assets are real. So I don't know much about accounting, but I think there's something out there about liabilities have to equal assets. But if one of them is dollars and the other is goods, you got to divide by P. And so that's what I'm going to think of as the price level. It's going to be the number of units of liabilities it takes to buy some basket of goods. Okay, well, you can go from this into a demand for total government liabilities. And what are they going to depend on? Well, there's going to be a price, Q, and then you're going to have the assets are not just the assets that the government has today, it's going to depend on all future assets that the government can generate. And those assets are revenues, less spending, not including interest payments. So you automatically get to this market for total government liabilities. And here I'm just lumping all those liabilities together. You can differentiate them. That was sort of what Jim Tobin did with his research, was thinking about different kinds of liabilities, and you have different demand functions for each of them. But for conceptual reasons, it's convenient to put it this way. And that now suddenly you see this is where monetary and fiscal policy both show up. You cannot separate the two. The way that a guy like Tom Sargent would say is monetary and fiscal policy meet at the government budget constraint. And so I think of fiscal policy as primarily setting total liabilities, and they choose what the primary surplus is going to be. Monetary policy is going to affect the prices of these liabilities through interest rates. It also can change the composition, large-scale asset purchases change the composition of those liabilities. And as I'm going to emphasize a lot, it can actually also affect the level of liabilities. And I'll get to that in a little bit. So monetary and fiscal policy just inherently interact to determine the price level. Okay, now I'm going to go through the monetary narrative. And this first picture, which you may not be able to see very well, the blue line is M2 growth. The red line is CPI inflation in the United States, starting before COVID and going up to the present. I first saw this picture on the door of one of my colleagues' office, and he was a hardcore monetarist. You didn't know they still existed. They do. And this was his way of teaching his principal students about the causes of inflation. And so when I saw this picture, I tried to convince him that, well, maybe you need to go a step or two farther than this. So here's the first step. What caused M2 to grow? Well, liquid deposits growth. Well, that's natural to expect, right? That's what basically M2 is. It's a bunch of liquid deposits. But then you've got to ask, where did those deposits come from? Well, coincidentally, the US government sent a whole bunch of transfers to businesses and individuals during COVID. What did they do with those transfers? Well, they put them in their bank accounts. Okay? Now, so when I tell him that, he still ends up saying, well, but it's M2. And so then you got to ask, well, so what should the Fed have done? Not allowed them to deposit their transfers? And we would therefore not have had inflation? Is that the reasoning here? So the last picture shows you the purple line is government debt growth. in the United States. Gosh, that looks a lot like, I could have just started with this picture and said, oh, look, government debt causes inflation. So that's the monetary narrative, the traditional monetary narrative that comes out. And what I would argue is that if you look at this last picture, what was really going on was the price level was adjusting because suddenly there was this big increase in government liabilities with very little increase in surpluses. And so those liabilities had to get revalued. Price level went up. The real value of those liabilities went down to match what people thought was going to happen to surpluses. Okay, so the second element of the monetary narrative is a committed and independent central bank can control inflation. Well, the idea of commitment, I don't have any problem with that. That gets you closer to the Ramsey solution, the fully optimal policy. And the idea of independence is it then frees monetary policy from political pressures. But the idea here is that if left unfettered, monetary policy can always control inflation. So the combination of commitment and independence are both necessary and sufficient for inflation control. Now, I have recently become a big advocate for not using the word independent without a modifier. Because you have to ask, what does that actually mean? Well, clearly central banks are not politically independent. They are the creatures of the political process. And they were created by the political process. They are given a mandate by the political process. They are inherently political. Let's not pretend that it's not political. I think they are operationally independent. But the third modifier there, economic, is the one that worries me. And again, when I talk to journalists, I get this all the time, that, well, the big difference between the US and Argentina is that the Fed is independent, right? Yeah, but they're not economically independent. You can never be economically independent. And I think when we use the word independent, lay people don't understand what we mean, and they seem to think that means the central bank can do whatever it wants and achieve whatever it wants, regardless of what's happening on the fiscal side. So I was going to show you some theoretical counterexamples, but given the audience and the fact that Olli this morning, or earlier today, alluded to this, I'm just going to describe what I think is a beautiful counterexample to this idea. And that is, you look at the period before COVID, and you look at the Eurozone, you look at Sweden and Switzerland. What was going on there? The central banks were trying mightily to get the inflation rate up. And Switzerland is like the poster child for this. They had the biggest negative interest rates, policy interest rates. They did massive intervention to try to prevent the franc from appreciating as much as it did. And they even had 30-year bond yields that were negative. Sweden also had up to 10 years occasionally were negative, 5 years were pretty negative. Germany, same thing. So why was that? Well, what were fiscal authorities doing? Contract, contract, contract. If you look at net lending, primary net lending, boom, coming out of the great financial crisis, Germany quickly started to run surpluses. If you look at the level of debt GDP in Switzerland or Sweden, it's hard to even see that there was a financial crisis. There's a little tiny bump, but basically it just steadily came down. So we were in an environment where the central banks were all independently deciding to try to expand, and fiscal authorities were independently deciding to contract. So clearly you need a little more than commitment and independence for the central bank to control inflation. So I'll skip over this. Now, this is another one that happens all the time. Contractionary monetary policy that raises the interest rate reduces inflation. I think almost everybody in this room would agree with that statement. I agree with that statement. And I don't need to go through this, but I will. So the idea is that you raise the nominal interest rate and the real rate goes up, at least for a while. Firms and consumers will substitute out of current demand and into future demand. Other aspects of the transmission mechanism reinforce that contraction in demand. Output falls below potential. Firms reduce prices in the face of depressed costs and demand, and inflation falls via the Phillips curve mechanism. Okay, let's see beyond that. Well, higher interest rates raise interest payments on the government debt. So this last fiscal year in the United States, it was $1 trillion. The year before, it was $850 billion. So these are non-trivial numbers. So what does that do? Well, you've got these bondholders who are receiving more interest. If those interest payments aren't met with future taxes, then they feel richer, right? It raises their permanent income. And that then raises their demand. That would tend to drive up inflation. So you've got these competing forces going on whenever the central bank raises the interest rate. So what this proposition forgets to mention is that, well, something has to wipe out that wealth effect. So we'll do a little old-fashioned micro in a new Keynesian model, and we'll take the total effect of an interest rate hike and we'll decompose it into substitution and wealth effects. And so if you look at the red line, or actually on the left is the policy rate, that just goes up and then decays back. If you look at the red line, that's the pure substitution effect. Remember that a pure substitution effect means that you're just moving demand across time. The total amount of demand doesn't change. And that's what this output picture shows, that initially output falls and then it goes up. But in the new Keynesian model, the way inflation gets generated is it depends not just on the current output gap, but on all future discounted output gaps. And guess what? Inflation only rises. So the story we tell about substitution effects isn't really what's going on. What's really going on is there's some whopping big wealth effect. It's the wealth effect that actually allows this contractionary policy to reduce output and inflation. So then you say, well, but where does that wealth effect come from? This is where the magic happens. It comes from unstated assumptions about fiscal behavior. Because what's happening, as I said, interest payments are going up, right? And if inflation actually falls, then the amount of nominal liabilities out there, the real value of that goes up. Well, if the real value of that goes up, the assets have to go up. So that's what's going on in this picture. That real debt goes up because interest payments also go up, and then voila, as we say in Central Virginia, taxes rise. Now, this is a phenomenon that matters more the more indebted you are. So when we were talking about economies around the world becoming more indebted, you should be aware that the fiscal consequences of monetary policy are going to get amplified. So this proposition relies on there being a fiscal response to the monetary contraction. So another way to think about what's going on here is you have monetary contraction is followed by fiscal contraction. That's what makes everything tick. Okay, now Ben has been mentioned, so let's conjure up Ben again. This comes from the classic book that I think probably a lot of you have read. Maybe you keep it under your pillow at night, next to your Woodford. An effective commitment to long-run price stability is a nominal anchor. A target rate of inflation communicates to the public the price level the central bank is aiming to achieve at specified dates in the future. What is this designed to solve? Well, there's a well-known problem in monetary economics that if you have fiat currency, there are always bubble equilibria, sort of like crypto, right? You value the currency if you know that somebody in the future is going to value it. If you think the value of the currency is going to go up in the future, then your demand today goes up. That's exactly how crypto works. It's not backed by anything, okay? So what this quotation is asserting is that if you announce a pi star and you credibly commit to achieving it, then you can wipe out all these speculative hyperinflations. And therefore you can anchor what long-run expectations are. So the question I ask is, well, what is it about monetary policy that's fundamental? Right? The problem with fiat currency is there's no fundamental value to it. Right? So what is it about monetary policy that is fundamental that allows this inflation target to be credibly, to anchor expectations? Or to word it differently, can a purely nominal commitment anchor beliefs? Now, in the theoretical literature, implicitly, there are adjustments to fiscal policy that validate the hyperinflations that occur. So if those assumptions about fiscal policy don't hold, you can wipe out all those bad equilibria. So what I'm going to do is talk about very briefly about two different nominal anchors. One is a gold standard, and then I'll use the price level target instead of the inflation target because it's just a little easier to reason through. So what's going on in the gold standard? Well, the government announces that it'll exchange gold for dollars at some fixed parity, call it G star. Now, credibility then relies on people believing the government will acquire whatever gold is necessary to fulfill this commitment, right? Well, how do they get the gold? They raise taxes so they can go out and buy the gold. So it's the government's command of resources that makes G star credible. And to me, the big difference between monetary and fiscal policy is that you guys aren't allowed to raise taxes, right? That's for the people down the street to do. So you don't have any command over real resources the way that the elected officials do in the parliament. So the gold standard explicitly carries a fiscal commitment. And this was a point that Kidlin and Bordeaux made some years ago. Now, what if you look at a price level target? Well, you've got the central bank promises to do whatever it takes. But here's the problem. Nobody can demand goods for dollars. That's what fiat currency means, right? So whatever it takes has fiscal consequences. And they're exactly the ones we just went through. If whatever it takes means you see inflation go up, so you raise interest rates, well, you've got to have the fiscal commitment. So ultimately, just announcing a pi star isn't going to do the trick. And that's partly why it's so important that central banks were created by the legislatures, right? That there is this implicit commitment. And unfortunately, it's only implicit. And in the United States these days, it doesn't seem to exist at all. So that tells you that pi star as a commitment device is pretty fragile. It's sort of beyond your control. You could do everything right, and it won't matter if the taxes aren't there. Okay, so this is, since we're talking about stars, we're going to talk about stars. So there is this idea that if central banks just track R star, and Governor Jefferson was very diplomatic about his answer in this regard. So you just set the interest rate equal to R star, whatever R star today is, your best guess, plus the inflation target, then monetary policy can offset any shocks that affect demand. Okay? It's a theorem, so it must be true. And so the idea is that R star reflects all sources of demand that are hitting the economy. And what happens is if R star goes up because of some shocks that hit the economy, the central bank, that's going to increase demand. The central bank has to raise the nominal interest rate by enough that the real interest rate goes up exactly by the change in R star to offset it. And that wipes out the demand effects. Okay? So I was at a conference at the Bank of Korea, as you know. And it was all about R star. And it's always interesting to hear central bankers talk about stars because it's not clear that they're really committed to it. And I think it's certainly true of Powell. Powell's really cagey when he talks about R star. And he talks about it as, well, you can see it in the rearview mirror. Well, we knew last year monetary policy was tight because we saw inflation come down. Ergo, I was bigger than R star. Not terribly useful as a tracking device. Okay, so this proposition as it's stated is incomplete because the question is, what's going to clear the government budget constraint? Again, you've got to be talking about an equilibrium. So any change in the policy rate is going to affect government budgets. It's going to affect bond prices. It's going to affect future interest payments and so forth. And so the outcome is going to depend on fiscal backing. And here I'm just setting aside all the practical issues of, well, what is R star anyway, and how should we estimate it, and why are those probability bands like this? Who was I talking? I was talking to somebody recently who was saying that like the probability bands were anywhere from -2 to 6 or something. Okay. This, as you can see, that the captain of this ship, if you could see her from the front, you would see that she's wearing a scarf. That's in your honor. So this is it's amazing. It's amazing what AI can do. So I just created this little cartoon. So, Captain, why star is falling? Looks like 25 basis points north. And that's how she's going to steer the ship. But what I'm going to do instead is just show you in a new Keynesian model what happens when you do and don't have the fiscal backing. Okay? And it's going to be a transitory, meaning a pure one-period increase in government purchases. So that's what's going to raise R star, right? Government's going to go out, buy more goods today, aggregate demand rises. So the story is the central bank will then raise the nominal interest rate by enough so that the real interest rate goes up by R star. Boom, all demand effects disappear. So that's the first scenario. And the second scenario is that's going to be unbacked. Fiscal policy is not going to do anything. And I'm using the example is government purchases, but it could be any shock that raises R star. Okay, so this is when the narrative works. The natural rate goes up, that's up there. They raise the nominal interest rate. Everyone expects inflation's not going to change, so the real interest rate goes up by exactly enough. Nothing happens to output and inflation, but real debt goes up, so you got to have the fiscal backing, taxes. What if you don't have the fiscal backing? Well, exactly the same responses in the first the natural rate went up by the same amount, nominal rate went up by the same amount, but now you get this persistent increase in the output gap and inflation. And so if you don't have the fiscal backing, you can be tracking R* all you want, and it's not going to deliver the goods. So I'm going to skip this one and just get to the conclusion. This comes from Rogoff's new book, which is an interesting book. But he seems to say that outright default is something that needs to be on the table in the United States. And what I did was a little bit of legal stuff to figure out whether it's legal for the federal government to default on debt. And it turns out it's unresolved. It's an unresolved legal issue in the United States. Okay, so let me just end by raising some questions. I think once you start thinking in this way, all kinds of questions come to mind. Like, how grounded are our policy institutions in the monetary narrative? I would assert that they're completely grounded in the monetary narrative. Because we create these independent central banks and we say, okay, you go do your thing. And in some countries, like Sweden, they do have a fiscal framework, but it's mostly designed to just keep debt at a low level. It's not designed to give the backing to monetary policy that's necessary. And that's why, before COVID, we had this conflict between the two. And then if you acknowledge that there are these fiscal foundations, how would we change these institutional arrangements? Should we redesign the institutions? I have been advocating for some years that, at least in the United States, the Federal Reserve needs a plan B. What do you do if you are in fiscal dominant world? Maybe in secret they talk about that, but I've never had a governor, even in private conversations, say to me, oh yeah, that's a possibility we think about. And then it occurred to me that there's this weird inconsistency. You know, the whole idea of independent central banks is we can't trust elected officials to control the money supply. That's the whole idea. Why do we trust them to print whatever debt is needed? I don't understand that. There's some disconnect there that somehow the money supply matters more for inflation than debt does. And if you go back to pre-New Keynesian days, I'm old enough to know this, and there may be one or two of you out there who also do. You grow up thinking that debt is a problem. Debt can cause inflation. When Roosevelt was facing deflation, and he ran fiscal policy that created an expansion in nominal debt, the banking community was up in arms that he was going to cause hyperinflation when prices were still falling. Now we don't even talk about it. So I think we need to ask these questions, and I can end there since I'm ticking down.
Thanks a lot, Erik. I think that was a very entertaining, hardcore monetary fiscal theory that actually keeps me awake every now and then. I think we have time for a few questions. Who wants to start? You met? Okay. Okay, go ahead. You saved me.
Thank you. Jarkko Soikkeli from Varma. One question. Reinhard Rogoff tried to kind of establish certain level of debt where this kind of economic independence might be somewhat problematic. And do you have any kind of numbers on your mind that whether we are, and if we are, how far above those debt levels already are that governments basically prevent central banks from raising rates to 10 or 15% because it's unsustainable?
No, I don't think that's the way to think about this. If the debt GDP ratio is rising, then what the theory says is people are expecting surpluses to go up in the future. So what Reinhard and Rogoff are really looking at is countries whose debt is not denominated in their own currency. Then there's no option but to default. So the part that I skipped over is that in the United States, and this would be true in Sweden and Switzerland and any number of other countries, you can devalue the debt through inflation. And that's almost always less costly to society than outright default. So I don't think about it that way at all. So I'm not going to give you a number because I don't think about it that way. I think what you want to do, there are lots of little signs that fiscal dominance is creeping up on you. So I'll throw out some from the United States. First of all, the tradition in the United States is that you at least pay lip service to fiscal consolidation. 5 days after Obama got his stimulus package passed during the great financial crisis, he pledged to reduce the deficit by 1/2 by the end of his first term. And he did it. So we haven't heard any of that. Another sign is the treasury market problems that the Fed has had to intervene for in March of 2020. If you read the newspapers, they tell you, oh, there are market microstructure problems. But it's having those problems because the supply of treasuries is overwhelming the capacity of dealers to handle it. So there's an underlying fiscal reason for those problems. If you look at some of these auctions that have happened, they've been weak. The demand for long-term US treasuries has been pretty weak. And yeah, each of those in isolation is no big deal. But when you start to see these things happen repeatedly, you start to think there's a pattern. And you know, foreign holdings of treasuries has fallen from over 50% to about 35%. I think that means something. So that's how I would think about it, rather than find some magic number that if you cross it, then all hell breaks loose. I don't think that's how the world works.
Thanks. Please.
Thank you. Päivi Puonti from, can you hear me? Yes. From Etla Economic Research. Thank you very much. I'm very much interested in the monetary fiscal interaction. In the beginning, you mentioned that you look at this from the perspective of United States. Well, maybe to some extent this was acknowledged in Europe, because when the euro area was set up, from the beginning of the euro area, we've had some fiscal rules in place in Europe. Exactly because we have understood that to guarantee independent monetary policy to the central bank, we need to contain public indebtedness. Well, these rules have not worked that well. They are very complex. And I couldn't imagine these kind of rules being in place in the States. So what would you suggest?
I have a crazy suggestion that it was actually something I suggested in a Jackson Hole paper in 2010 or something. It was entitled Monetary Science, Fiscal Alchemy. And my claim was that, you know, we understood what incentives politicians face when it comes to monetary policy, and we did something about it. They face the same issues with fiscal policy. And so I have thought that it would be useful to try to have certain aspects of fiscal policy, the aggregate things. What should be the primary surplus? What debt GDP ratio should we be shooting for, et cetera, determined outside of the political process. And then in a democracy, of course, the elected officials have to be making the allocation decisions about taxes and spending. Because the problem is, you know, all these efforts to put rules on elected officials, or in the United States, it's all sort of self-governed through Congress. They had these traditions and norms that they followed. Those have all been thrown out the window. And the problem in Europe was that the rules got so complicated because they tried to cover so many different contingencies. And there's another sort of nuanced issue there too, which is that the way I'm talking about these policy interactions isn't, oh gosh, you know, the central bank has to run the printing presses. That's the problem that a lot of fiscal rules are designed to solve. And that, I don't think, is really what our countries, all of these advanced economies, they don't face that problem. So the fiscal rules are all about trying to stabilize debt, keep it at some level. And they're not thinking about the fiscal backing that I'm talking about. And that's why you can get conflicts. So I think the fiscal backing stuff is actually a little bit less onerous in some ways than what you were suggesting. But I just don't see the issue. We're fighting, you know, the 1920s hyperinflations. And I don't see that as the issue that we need to guard against right now.
Okay, thank you, Erik. Join me to thank Erik again for excellent speech. So we are about to finish the conference. Thank you so much for everybody coming here, and all the panelists and all the speakers. Has been really amazing day, I think. And Olli has promised us to summarize and conclude, give the concluding remarks. But before I let Olli on the floor, I wanted to thank one very special person behind the conference, and she is Riikka Virtanen, here in the back. She's been taking care of all the organizational matters. So Olli, the floor is yours.
Thank you, Juha. Thank you, Riikka, and the whole team. In fact, I want to try to be quite brief. I know that it's been a rather long, but I trust fruitful and productive afternoon. And I want to very warmly thank all the keynote speakers, policy panelists, participants of this conference. At least I have learned a lot, and it takes some time to digest everything that I have been and we have been hearing and listening to in the course of this afternoon. And I want to correct one misunderstanding, which is that I'm certainly not against artificial intelligence. Quite to the contrary, I'm an active user of AI, and I really wish I had ChatGPT to do the conclusions. I don't know why I actually agreed and promised to do the conclusions, because we've had such a variety of viewpoints and plenty of important analysis in the course of today. It's not the simplest task, but I will. Let's try. Because we have several important takeaways from this conference that I would like to share with you briefly. First, President Christine Lagarde pointed out that Europe's exposure to the escalating trade tensions underscores how intertwined economics and geopolitics are today, with tariffs now used as instruments of power rather than mere protectionism. And she also underlined, in my view, very rightly, the resilience of the European economy under the current circumstances. Expectations of strong inflationary effects from US tariffs have not materialized as retaliation has been limited. The euro has, in fact, appreciated, not depreciated, and as supply chain disruptions have remained contained. So the trade shock has not created in Europe new inflationary shocks, and inflation in the euro area is now at around our symmetric 2% target. However, we are navigating a more difficult environment than before. There are still known unknowns and unknown unknowns. As President Lagarde pointed out, we need agility, structural reforms, and deeper European integration to sustain our resilience and boost productivity and sustainable growth under this pervasive uncertainty. And I think Christine Lagarde also rightly pointed out that amid this cloud of uncertainty, we need a certain degree of humility, because this uncertainty is taking us to very uncharted waters. Second, today's discussions have shown that today's challenges are global, affecting policy debates across Europe, the United States, and beyond. Vice Chair Philip Jefferson offered us a valuable comparison of the Fed and ECB strategy reviews or assessments. Despite certain differences, his remarks highlighted many shared principles between the ECB and the Fed in how they approach monetary policy. He emphasized that a clearly communicated framework centered on the 2% inflation target is essential for anchoring expectations and maintaining credibility. And he also offered a clear illustration of how a robust strategy framework can guide current monetary policy decisions. And moreover, I think it's worth noting that today, after the most recent reviews, both the ECB and the Fed also are practicing flexible inflation targeting, and there is no main role for make-up strategies anymore. Drawing on his extensive experience in global macroeconomics, Reza Moghadam offered a valuable perspective on the interplay between markets and politics, institutional arrangements, and central banking. He illustrated how the credibility of institutions and policies do shape investment sentiment and, of course, the operational environment of monetary policy. And with the case studies of Brazil and the euro crisis, Reza reflected how central bank independence can work as an anchor of stability in the events of major financial stress. And he also underscored the importance of the lender of last resort in times of financial turbulence. Then we had a lively and insightful panel discussion that highlighted several acute challenges that policymakers are facing due to increased uncertainty. The panel underlined how geopolitical and trade policy uncertainty have reshaped monetary policy making across Europe. As highlighted by Agnès Bénassy-Quéré and Clare Lombardelli, the nature of uncertainty matters a lot on the optimal reaction to shock. And there was a lot of discussion concerning how to deal with the classical looking through question. We need to look the source and persistence of the shock while deciding to what degree to look through the shock. As Erik Thedéen noted, it is crucial to anchor expectations and we cannot risk de-anchoring them. Looking through is therefore not always possible. And the panelists also provided us valuable insights concerning the interaction of financial stability on one hand and price stability on the other hand. Erik pointed out that macro decision-making has developed a lot and works as a first line of defense against risks to financial stability. Agnès underlined the ability to react forcefully in monetary policy, and that needs a resilient financial system, and that's why macroprudential policy plays an important role in this regard. Clare provided us clear views on how scenarios can help crystallize narratives and relevant factors for the economic outlook in different contexts. And before ending this afternoon, Professor Erik Leeper reminded us of the challenges or dangers concerning fiscal dominance, and if I would take away something of his presentation, I took many things away from his presentation, but one is that we have actually a present danger of fiscal dominance, and we have to be honest about this risk and discuss and analyze its different phenomenon that are causing challenges to monetary policy and central banking. Erik reminded us that understanding inflation requires looking beyond the central bank to the fiscal realm. Fiscal and monetary policy interact in ways that may affect inflation expectations and real economic outcomes. So, ladies and gentlemen, dear friends, the discussions at this fourth monetary policy conference organized by the Bank of Finland have reinforced the importance of scenario-based thinking, of clear and comprehensible communication, as well as analytical openness and even humility in today's world of heightened geopolitical tensions and pervasive uncertainty. Therefore, a well-designed monetary policy strategy is essential, as it can enable central banks to respond to shocks with coherence and confidence. It can provide a clear anchor for expectations while allowing flexibility in the face of uncertainty. And the conference has clearly highlighted the role of central bank independence as the safeguard for stability, growth, and public trust. So let me close this conference by warmly thanking all the speakers, panelists, commentators, participants for your thoughtful contributions and active engagement. Together, we have deepened our understanding and reinforced the foundations for future policy dialogue that is essential and necessary as we navigate the evolving challenges of monetary policy in an increasingly complex and fragmented world. Thank you very much, and have safe travels. Thank you.